Hello guys, we are back and we are live. Today we'll be covering the income from capital gain chapter. We'll be trying to cover most of the provisions, all the concepts, illustrations from ICA material. Just let me know if my audio, videos, everything is fine. Hello, let me know if we are having any issues with respect to audio, video. Okay, so let's start. I think we are live and we are not having any issues with respect to audio and video. I can see myself and I can hear myself properly. So let's start. Income from capital gain, like as we all know that there are 5 hits: salary, house property, PGBP. Yesterday we have covered PGBP. Today we'll be focusing on income from capital gain. Here there are few definitions which are important for us to understand. Not that they are important for examination purpose, but at least for our for us to calculate the problems and solve the problems, understand the concept and everything. There are few definitions which are absolutely necessary in income from capital gain chapter. So one is, so when we go to section tax under income from capital gain, as always, like I will be focusing more on the charging section section every time. There is a general provision: any profit or gains arising from transfer of a capital asset affected in the previous year shall be chargeable to income tax under this head in the previous year in which the transfer took place. So here we can understand that they are saying any profit or gains that you are getting by transferring a capital asset. So we need to understand what is the definition of and then we need to understand when you call something as a transfer. So unless we go ahead and understand these two terms, like what is capital asset and what is a transfer, there is no point in reading the entire section. Yeah, so first we'll be focusing on what you mean by a capital asset. Capital asset bole to property of any kind held by an assessee whether or not connected with his business or profession. So property of any kind whether or not it is connected with your business. What does that mean? See, I'm having a building which I'm using it for my personal thing, so it is not connected to my business, but still it is a capital asset. So capital asset doesn't mean that only for a business person, even for an individual also. Maybe in your personal life you might have come across, like you might be selling some land or building and purchasing another land and building, so you will be subjected to capital gain tax. So that is the reason why they are saying whether or not connected with your business. So even though it is not connected with your business, still you can say it is a capital asset if it is meeting the other definitions. Any securities held by FII. So generally inventory is outside the scope. For any manufacturing company or any trading company, they'll be purchasing lot of material, lot of stocks or goods, and then they are selling it, right? So they are generally paying their PGBP income only, so they need not again calculate the capital gain tax. So that is the reason why inventory is excluded from capital gain chapter. But for foreign institutional investors, just to attract them more, what the government has thought about is that for FIIs also, even the securities that they trade in, like purchase and sale, still that will be a capital asset. It's not a inventory. See, for any other business, buying and selling of your own business, your own commodities, like your inventory, so that should go to your PGBP. But for FII, even though they are dealing with the purchasing, buying and selling of these securities and instruments, still they will be paying tax under income from capital gain. Then unit linked insurance. So this is an amendment, guys. Whoever is watching, just pay attention here. Earlier it used to be like ULIPs were unit linked insurance policies. These used to be exempt everywhere, but government is like, okay, why should we give exemption to everyone? People who are having lot of cash, lot of profits, lot of income, they are also put money into the ULIPs. We will give a cap. Cap is like, if you are contributing more than 2.5 lakh, only up to 2.5 lakh only it is exempt. More than that it is taxable. So that is the reason why any unit linked insurance policy issued on or after this date. So on that date there was an amendment, 1st Feb 2021, to which exemption under section 1010D does not apply on account of. See why they are not getting exemption? This is a condition. Premium payable exceeding 2.5 lakh for any of the previous years during the term of the policy, or the aggregate of amounts of premium exceeding 2.5 lakh in any of the previous years during the term of any ULIP, in case where the premium is payable by a person for more than one ULIP issued on or after 1st Feb 2021. In layman terms, before this date, if you are contributing anything to ULIP, that used to be not a capital asset, on maturity, like following other condition, on redemption or maturity also, you are never paying tax on that. After that amendment, like 1st Feb 2021, there is a cap. When you are contributing into ULIP, you can contribute any amount, but the exemption is only up to 2.5 lakh. It can be one policy, one ULIP, or it can be multiple. See, if you want to make an investment, doesn't mean that you will make only one investment. Is it not like that, right? It is not like that, right? You'll only invest in post office savings, or you'll invest only in FD, you'll invest only in, not like that, right? If you want to take FD also, you might take it in 4 or 5 banks. It is a possible. Like that, if someone wants to take multiple ULIPs put together, all combined together, if it is exceeding 2.5 lakh on or after this date, remaining is a capital asset. On redemption, when you get back your money, you have to pay tax on that. So put it in a very normal language, any asset or any property, whether or not connected with your business, for FIIs, their own instruments, even though it is a stock in trade for them, but still it is a capital asset, plus ULIPs which is not meeting that exemption, like which is exceeding the limit of 2.5 lakh, even that also a capital asset. But it does not include stock in trade. Just now I was telling, for a manufacturer, for a trader, I will be dealing on a daily basis, number of goods I will be selling, number of goods I am purchasing. So I'll be paying capital gain tax on that, right? So that is the reason why stock and trade is outside capital gain chapter. Personal effects like wearable, apparels, furniture. At my home, I have my own furniture, like the where I am keeping my laptop. If I sell this, no, I will not be paying it, because they're all personal in nature. But personal in nature also having certain exceptions, certain exclusions, like jewelry, archaeological collections, drawings, paintings, sculptures, any work of art. So even though I am drawing something and it is my personal, you cannot say that I will not be paying tax. It is, though it's personal, but it will be having lot of value, so you can generate lot of revenue. Bulke, they are keeping these outside the exceptions, which means that these are all taxable under capital gain. These are taxable under capital gain. Next, rural agricultural land in India. It's again rural agriculture. It is not urban agriculture like in our area, wherever we are staying here. It is a specified area. So if I have an agricultural land here, or if I am selling that land, I cannot say that it is outside capital gain, even though it is an agricultural land, but it is situated in a specified area. So what do you mean by that specified area? Any municipality or cantonment is having a population as per the latest census 10,000 population, that is a specified area. But if the population is between 10,000 to 1 lakh, 1 lakh to 10 lakh, 10 lakh and above, okay, 268, you remember this in examination, between 10,000 to 1 lakh population, as per the latest census, if the population is between 10,000 to 1 lakh, radius mein, like it is like a pie. If this is a cantonment area and the population is more than 10,000 and less than 1 lakh. It is 2 kilometers radius measured aerially. Okay, so between 10k and 1 lakh, 2 kilometers you will go. If the population is 1 lakh to 10 lakh, you will go bigger population, like larger area, no? 6 kilometers. If it is 10 lakhs and above, 8 kilometers. So if your land is if your land happens to situated in this area, that is a specified area, it is not outside capital gain, you have to pay capital gain tax on that, provided other conditions are specified. Then specified gold bonds. This is also like government, whenever government wants to push something or wants to encourage or need funds for some certain thing, they'll be saying this is outside the definition of a capital asset. Then people start buying because they know whenever they sell, they'll not be paying tax. So specified government bonds and specified bearer bonds and gold deposit bonds. Just by looking at the name, you can understand these are generally given by RBI or government, so they are raising money in some or other form. So these are all outside the definition of a capital asset. So far where we are is, while reading section 45 subsection 1, that is the general section for your capital gain chapter, we need to know what is a capital asset and we need to know what is a transfer. Just to understand this, first we are focusing on capital asset. Capital asset is like property of any kind, whether or not connected with your business, plus FII, whatever the instrument they are dealing, plus ULIP if it is exceeding 2.5 lakh, and these are all your capital assets. But there are certain exceptions. Exceptions may your personal apparels and special agricultural land, special bearer bonds, gold bonds, bonds, rural agricultural land. These are all exclusions from the definition of a capital asset, which means that on transfer you will not be paying tax because it is failing to meet the definition of a capital asset only. Okay, so now we kind of little bit understood what you mean by a capital asset. Then we need to understand what you mean by a transfer. Capital asset, there has to be a capital asset and there has to be a transfer, then only this chapter will be applicable. So chapter 2 clause 14 will talk about when you call something as a transfer. So this is a transfer. Hope you are understanding this point. One is a capital asset, we have to really understand what is a capital asset. Then transfer. So once there is a transfer, it will come under capital gain chapter, and then we have to understand when you call something as a long term, short term, then what is the rate, exceptions, cost of acquisition, all those things. First, what do you mean by a transfer? Transfer bole to a sale or exchange or relinquishment. In normal balance, we think that okay, only on a sale there will be a transfer, but the fact is that it's not necessarily be a sale. It can be an exchange, like you have an asset and you're exchanging that asset with some other asset, or you're relinquishing the right in an asset, like you have a right in a property, not like sole prop, like there is a building, I'm having only 25% of the stake in that building, I'm relinquishing my right, so that is also a transfer. Extinguishment of any rights, compulsory acquisition under any law. So what does this mean? I'm not selling land on my own, like not a free will. Government is forcing me to sell my land, so it is a compulsorily acquiring my land. Even then, it is a transfer. Okay, you cannot say that no, I didn't give consent, they forcefully took it from me. Even then, it is a transfer. Owner of a capital asset may convert or treat the same into stock in trade of a business carried on by him. Such conversion treatment is a transfer. What does that mean? I have a capital asset, like I'm having a huge land, and that is my capital asset at the moment. But going forward, I thought that instead of doing any other manufacturing or any other business, I want to get into real estate. So I want to make plots and sell it to everyone. So I'm converting my capital asset to stock in trade, right? So even that is also a transfer. You will not be paying tax when there is a conversion. Yes, on conversion it is a transfer only, you have to pay tax, but the real liability will arise only when you eventually sell that plot, okay, that inventory. Coming again, if you have a capital asset and which you want to convert it into inventory, yes, you can convert, that will be a transfer, but you will not be paying tax now. Eventually, whenever you sell these inventories or the plots to the consumers, ultimately that time you will be paying tax. Okay, so maturity or redemption of zero coupon bonds is also a transfer. We are spending so much time because unless these two definitions, it's difficult to understand the whole chapter. Possession of an immovable property in consideration or a part of performance. So this is like a transfer bole to it's not like you have to get it registered. Yes, that is eventually will happen, but if the majority of the consideration has already been received, risk and reward has been transferred to the buyer, then you can say I have transferred it. Assuming that I'm having a building, I'm selling it for 1 crore. 80 lakhs that guy has given, 20 lakhs is pending, registration is pending. I gave the possession to him, like I vacated the premises and he is coming and is using the premises now. So risk and reward has been transferred to him. Majority of the portion of the amount has been given to me. So then I can say that this is also a part consideration as per this act, Transfer of Property Act 1882. Still that is also a transfer. Registration is not like absolute necessary condition here. Transactions which have the effect of transferring or enabling the enjoyment of immovable property, like a patent example. So at the moment that I'm only using it, but future may I'm like for Hyderabad location I'm giving it to someone else. So I'm enabling the enjoyment of an immovable property to one party. Okay, so earlier I was having the exclusive right to use everything on my own, but at the moment a part of it I am giving a right to someone else. So enabling the enjoyment of using the immovable property, so then also you can say it is a transfer. So now it is clear, right? We are into capital gain chapter 1. There has to be a capital asset, then there has to be a transfer. Both are now mostly clear. Now we'll go to understand when you call something as a long term or short term. Earlier it used to be 36 months for something to be called as a long term. They changed it to 24, but still there are certain assets which needs 36 months criteria. For 12 months criteria, like if something is held beyond 12 months, we can say that is a long term, otherwise it is a short term. Securities other than units listed in a recognized stock exchange. So whoever is dealing in shares, you have to hold it for 12 months, then only you can say that is a long term, otherwise it is more than 12 months, it's a long term. Only 12 months or less than 12 months, it is a short term. Units of equity oriented fund or units of UTI, unit trust of around it, not like they simply don't ask what is a short term, what is a long term. Eventually when you calculate, should you be using which rate, like while setting it off also, which is permissible, which is not permissible. Equity oriented fund and zero coupon bonds, all these things, if they are held for a period of more than 12 months, you call it as a long term, otherwise it is a short term. And unlisted shares, like there is a company, example, I have only started my company, after 4 or 5 years I am trying to sell my shares to one of my friends. Okay, it's not like public, only my friends. So my shares are not traded anywhere in the market, right? So these are unlisted shares. So for them it is at 24 months. If it is listed, it is 12 months. If it is unlisted, it is 24 months. Land and building, it used to be 36 months, but now it is 24 months. Just remember this. You might have to consider this while calculating the problems. And then for 36, debt oriented fund. See, equity oriented fund, it was 12 months. Debt oriented fund, it is 36 months. Unlisted securities other than shares. Okay, so if it is unlisted shares, it is 24. Unlisted any other security. So security bole to you will have options, you will have bonds, debentures, anything, right? So if it listed, again it will go to 36 months. Other capital assets, one example I can give is whenever there is a slump sale, you will consider 36 months to say that something is long term or short term. I think we have a problem also, we'll be solving in some time. But today's turnout of the session is very low. At least yesterday there were few people. I'm not sure what is the reason, but still, yeah. So I hope whoever watching at the moment, this period of holding is clear. Just go with my pattern of saying it. When you start this chapter, first start with what is a capital asset, then what is a transfer, then period of holding, one by one. Like that's how you will peel out the entire chapter. And now we have regarding what is a period of holding. This is also important because see, it's not that everything that you only purchase and you only sell it, right? Maybe something that your parent has bought it and you are selling it. Maybe something someone might have given it to you for free. So should you consider their period of holding also your period of holding? Or amalgamation, amalgamated company, resulting company, demerger, there will be a lot of issues, right? So period of holding we understood when you consider 12 months, 24 months, 36 months. Now what all the period that you will consider? Is it only what you are holding in your hand, or is it held by the previous owner also? Yeah. When shares are held in the company in liquidation, so whenever there is a liquidation of companies, till the time the liquidation is happening, that time only you will consider. Post the liquidation, maybe see, today I am trying to liquidate my company, example. It is not that today only I will be selling off all my assets, right? It might take 3 months, 4 months. I need to find a buyer, I need to find a proper value for my assets. So the liquidator might take some time in selling off all your assets. Even then you call something as your see, like today is 22nd, right? 21st March 2023. Today we are planning to liquidate, but there might be a delay of 3 months or 6 months or 9 months or 2 years if the asset is very difficult to be sold. So the remaining period you will ignore it, okay? While calculating your period of holding, this is to be ignored. Subsequent to the date of liquidation, it should be excluded. When the asset becomes a property of the assessee by virtue of section 49(1), so like again we will come back to section 49 also. Someone else is giving you for free. Someone is like a partition of HUF, gift, like there are big list for under section 49. It is like you are getting something for free. Amalgamating company is giving to amalgamated company, demerged company is giving to resulting company, like that, okay? So here you will take the period held by the previous owner, meaning if I am giving you a gift, so I am holding it for 3 years and then I am giving it to you, and you are holding it for 2 years and then selling. So now if you want to calculate what is the period of holding, you should consider the period that I am holding the asset, okay? Period held by the previous owner also should be considered in calculating your period of holding to decide whether it is a short term or a long term, okay? Where the inventory of business is converted into treated as a capital asset by the assessee. Just now I said it. A land I bought it in 2015. Now it is 2023. I'm just taking the year only, not month and everything. So today here it is a land. So it's a capital asset. I'm holding this as a capital asset in my business. But on this date, on 2023, I'm converting it into inventory, right? Just now I said whenever there is a conversion of capital asset to inventory, it is a transfer. But what is the period of holding for this? This is also the day when you are converting. Till that day you have to consider what is the period of holding. Maybe I might be selling this plot in 2025. 2 years I'm holding it as an inventory. I'm not holding it as a capital asset, right? So this period of holding will not be considered. Only this period of holding will be considered in calculating my cost of acquisition or cost of improvement or index for cost of acquisition or index for cost of. Hope it is clear. Where shares in the Indian company, amalgamated company, becomes a property of an assessee in lieu of shares held by him in amalgamating company at the time of transfer, okay? So what do you mean by that? You are investing in a company of Good Limited, okay? You bought shares in 2019. Now Good Limited is getting amalgamated with a Bad Limited. So this is amalgamating company. amalgamated company. Alright, so now because this company is getting amalgamated with bad limited or getting absorbed by bad limited, because you are holding maybe example 100 shares, you are holding 100 shares in good limited, for that bad limited is giving 100 shares in their company. So as a shareholder you are receiving shares in amalgamated company in lieu of the shares that you held in amalgamating company. Okay, so because of that, this is 2023, right? This period should also be considered, like period for which you held the shares in amalgamating company should also be considered while calculating the period of holding for amalgamated company like bad limited. Okay, where shares or any other security is subscribed by the assessee on the basis of right to subscribe any shares or security, or by any person whose favor such right is renounced by the assessee. So what do you mean by this? This is a right issue. So I'm a company, I'm giving right shares to you. I mean, which means that you are already holding 100 shares. So I'm saying you can have 1:1. बोला तो you can purchase another 100 shares at a reduced price. If you are purchasing in the market, you might be paying 10 rupees per share, but I am saying you can pay only 9 rupees and take 100 shares. So it's I'm giving you a right to purchase my company shares, right? So this is the right issue. So period of holding should start from the date of allotment. So this is the general rule. In many places you see it's a date of allotment is a date till that you are selling it off. That should be the period of holding. Where the rights to subscribe to any shares or security which is renounced in favor of other person, it is a date of offer. Like you are renouncing it to someone else, which means I'm giving you a right. Boss, if you want, you purchase 100 shares in my company, but you are like, no, I will purchase, I don't want to purchase, but I want to give it to someone else, like your friend. So when you are giving it to someone, that should be the date for period of holding. Where the financial asset is allotted without any payment. So this is the bonus shares. So I'm just giving you free shares. You're already holding 100 shares. I'm giving you 100 shares for 100 shares. You don't pay anything. That is like capitalizing my reserves, or I'm giving shares for free. So again, you will calculate from the date of allotment. That remember that what date of allotment is the starting date for any securities. Where shares in the Indian company being a resulting company becomes a property of the assessee in consideration of the demerger. So this is also same like amalgamation. One big company is becoming two companies, like they are splitting it. So big company is a demerged company. Small companies, now new companies are all called resulting companies. So if you are holding any share in the demerged company and they are giving shares in the new company, then that time you have to consider the period of holding in demerged company, just like amalgamation concept. Where units become the property of the assessee in consideration of transfers. So this is also not that important. Hope now we got little understanding of what you capital asset when you call something as a transfer, then period of holding, how you will calculate the period of holding and all. So again we'll go back to our charging section. The charging section says that for you to calculate something as a period of capital gain, there has to be a transfer, there has to be, then now we understood what is the capital asset, what is a transfer. Then whenever that happens, it should be chargeable in the year in which the transfer takes place. Whenever the transfer takes place, that is the year in which you pay the tax. Like today, if I'm selling you something, which means today the transfer is taking place. If the government is compulsorily acquiring it from me, today is the transfer takes place. But the thing is that if the land is acquired compulsorily by the government, do they make the payment today only? They'll not make it, right? They will delay the payment. So I cannot expect them to make the payment today, in this year. So I already lost my land. On top of that, you are asking me to pay the capital gain tax. This is really bad, right? So income tax also understand these practical issues. Say that generally, whenever there is a transfer, you have to pay capital gain tax. That's fine. But there are few exceptions. Exception is Insurance receipt, like whenever there is any destruction because of flood, typhoon, hurricane, cyclone, earthquake, or any calamity, riot, civil disturbance, accidents, anything like that, civil war. Okay, whether or not, whether with or without declaring the war. So like without declaring the war, only assuming our neighboring countries like throwing bombs on a particular state. So you can say that that is also a kind of a enemy action, or because of which you are losing something like property, land or something, you will lose it. You might have taken insurance. So insurance people also will take some time in doing their own analysis, research, confirmation, background verification, everything they do it. So they will also make the payment bit later. So whenever there is a destruction of an asset, it is a transfer, because you are extinguishing a right in your land or building or whatever the asset. For that you are receiving any other asset from the insurance company or any payment from them. So it's a transfer, but it is not taxable in the year in which the transfer takes place. Whenever there is a destruction, you will pay tax when the insurance company eventually makes the payment to you. ULIP also same thing. Yes, whenever you invest in a ULIP which is more than 2.5 lakh, it is a capital asset, but only when you redeem it, then only you will be paying tax on the ULIPs. Next, conversion or treatment of a capital asset into stock and trade. Just now I was giving one example. I was holding one land, it's a capital asset, and after that I am just converting my capital asset into stock and trade. It's a transfer, but whenever there is a transfer, I will not be paying any tax. This converted stock and trade, eventually I might be selling in next 5 years, next 3 years, right? That time I will pay it. Okay, so not combine the entire situation. Whenever there is a conversion of capital asset into stock and trade, it's a transfer, correct? Period of holding, you will consider only this much from the date of original acquisition till the date of transfer, till the date of conversion. That is only the period of holding. You will not consider the post conversion. Second point. Third point, when you will pay the tax when you eventually make the inventory sale. Whenever you sell that inventory, eventually you will pay the tax. But assuming that a big guy made some 20 flats, out of 20 flats, 18 flats I sold, 2 flats are still pending. So now should I pay tax on the entire 20 flats because I converted? No. Proportionately you will pay. Bole to out of 20, only 18 you have sold. So like that, out of conversion, you do the same thing, multiplied by 18 divided by 20. Only that portion you will pay it. On this, but we will not be solving the problems. We will be focusing on the concept only. And fair market value on the date of conversion will be your full value of consideration. I will tell you once again. In 2018, I bought one land. Okay, so this is my capital asset. In 2023, I am converting this capital into stock in trade. So this is the conversion. In 2025, I am selling this stock in trade. So one by one we will revise our understanding. Whenever there is a conversion, it's a transfer, correct? But when you will pay, whenever you eventually sell your stock and trade, you will sell here, you will pay tax. That is also proportionately. Proportionately bole to 20 flats I made, I am selling only 18 flats, right? So on this day, whatever is a fair market value, that will be my full value of consideration. Again, you have a section 48. The section says that how do you calculate your capital gain? Like, so first is sale consideration. Sale consideration bolte at what price you are selling your asset. So this fair market value on the date of conversion will be your sale consideration. I hope this is clear. So when you eventually sell these flats, no, you will have two incomes. One is capital gain, which you escaped at that time, and now business income. Both you have to pay. There is a example, but I am not solving this example. Introduction of a capital asset as a capital contribution, 45.3. As I said, 45.1 is a general section, default section, which says when you will pay it. Next, 45.3 is telling you when section that you can defer your payment of capital gain tax. Like I'm a partner in a firm, or I want to join as a partner in a firm. I don't have a capital. So what I'm saying is, boss, you can use my building for office purpose. So I'm contributing my building, my capital asset, as a capital contribution in a firm, right? So now where should I pay? Because I don't have money, then only I'm joining your firm by not paying cash, but by utilizing my building, right? So on top of that, you are saying I should pay tax, but it is not correct. I will not be paying any tax here, but I'll just contribute. So whatever I'm contributing now, it is a transfer, but I will not pay tax now. I will eventually pay when you sell it off. The profits and gains arising from such transfer will be chargeable to tax as the income of the previous year in which such asset such transfer takes place. Full value of consideration will be deemed to be recorded in the books of accounts. So while I am becoming a partner in a firm, obviously they would have been creating a partner's capital account on my name, right? So they would be recording Sampath's capital is this much. I'm not paying cash, but because of building, they are crediting something with my name, right? Like capital contribution. So whatever is the amount recorded in the books of accounts, that will be the fair market value. See, because generally they would have taken fair market value, but because it is a transaction between the partners, right? So people definitely try to misuse this. So that is the reason why whatever you are recording in your books of accounts, that itself is a full value of consideration that you will consider for your section 48. So Jacob, no, Jacob, I don't have any Telegram channel. Yeah. So where are we now? We are kind of repeating, guys, because only few people have joined. I really don't understand the reason behind it, but at least for the people who joined, I want to continue the session. We have started with a capital asset, then a transfer, then period of holding. Now, in which year you will pay the capital gain tax? Generally, in the year in which the transfer is taking place, you will pay it. But in the case of destruction of your asset, and you are receiving money from insurance, and when you are converting your capital asset into stock in trade, or when it is compulsorily acquired by the government, these are the exceptions to. So we are reading exceptions to the rule when you will pay capital gain tax. Then compensation or enhanced compensation, just now I was telling you this sections, it's fine if you can remember, but at least remember till 45, okay? 45, 2, 45, 3, 4, 5, if you can, it's fine, otherwise 45 is sufficient. So compulsory acquisition also same logic. Whenever government is compulsorily acquiring land from me or building from me, it's a transfer, you understood now. But I will not be paying the tax in the year in which they are compulsorily acquiring my asset, but in the year in which they pay the money. So it's on a cash basis, it's not accrual basis, okay, in accounting language. So whenever they pay money, or whenever they pay additional compensation or enhanced compensation, whenever they pay it, they might declare, but see, court might say that, okay, that is a very good area, why are you paying only 5 lakh, pay them 20 lakhs. They might order, but these people will go for another appeals, right? So that is the reason why until money comes in your hand, don't pay anything. Death of the transferor. So it so happens, I'll give you one example. There is Mr. X who had a land which was compulsorily acquired by the government. Take an example 2010, we'll take example. So it's a compulsory acquired by the government. So you know that it is a transfer. I repeated many number of times. So it's a transfer. In 2012, government declared 15 lakh as a compensation. Okay, 2 years they fought, they made all dharnas and everything, but still government is not at all paying. It's only court declared, sorry, I'm saying government, court declared 15 lakhs as a compensation or enhanced compensation. In 2013, Mr. X dead. Okay, he died. In 2014, government is giving to Mr. Y, who is a son of Mr. X, so which is like an inheritance property. Now Mr. Y is receiving this compensation as a father's property. Generally, what should have been the verdict? It should not be taxable in the hands of the son. because it is not like it's not earned by him, right? But what the verdict is, even if he was alive, it would have been deferred till the payment is made, right? Like if the father was there, it would have been delayed. It's not that otherwise it would have been delayed anyway, right? So whenever the compensation or enhanced compensation is received by the son, it should still be taxable. So that's what they are saying. Death of the transferor, whenever there is a death of a transferor, it should be taxable in the hands of the recipient. And we have taxability of capital gains in case of specified agreement. So specified agreement bole to I'll give you one example. I'm having a land in my area, 500 yards. Okay, all hypothetical, not reality. 500 yards, good area, good commercial place. Okay, 500 yards or 500 yards, we'll take that example. Good place, right? Not very big, but still sufficient. You can have some commercial space, you can have some residential space, everything like that. 500 is good. So now I don't have money to build any building on that. Okay, I don't have money to construct anything there. So I am the land owner. Because I don't have anything, I am giving this to a developer, and developer is like, Sampath, what we will do is, we will make 20 portions of a big apartment, 15 portions you take it because it's held by you, 5 portions I will take it. It just happens, it's not just theoretically. If you see in reality also, one big building will be built, and some portion like 20-30% of the entire building will be owned by the builder, constructor, remaining is held by the landowner. Okay, so this happens in reality also. Now the question is, when I am giving the right of the building to the builder, obviously I am relinquishing my right in the land, right? So as per our section, it should be taxable. 214 ke hisab se it is a transfer and I have to pay tax. But thing is that where I am not getting any money, that person is not giving. He has to construct the building. It might take 2 years, 3 years, and after that it has to be advertised for selling. Then someone will come and purchase. That time I'll have money. Now I will not be having any cash, right? So for them also there is a deferment option is given. So specified agreement, try to understand the reason behind it. For specified agreements also there is a deferment of payment of capital gain tax to the government, because the one who is relinquishing his title in the land is not getting anything in that at that point of time. He is waiting for some time, right? So that is the reason why they are saying you need to pay the moment you are transferring, or in the year in which you are transferring the right in that building. It should be taxable in the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. So if it takes 2 years or 3 years, it's fine. But the moment whenever it gets completed, at least it might take 3 years, assuming it's a very big project. So if it takes 3 years, and in the 3rd year they will be getting permissions from the local government competent authority that the building has been completed, some certificate. So in the year in which the builder gets a certificate from the competent authority, I have to pay tax, because that is ready for sale. Now I can sell if I want it. Full value of the consideration is the stamp duty value of the portion of the landlord, okay, or the land owner. Meaning, builder also, it is not capital gain. For him, it is a business, because there is no capital asset for him. Okay, in this example, out of 20 portions, 15 portions are mine, the builders, right? So he will be doing the PGBP only, no capital gain. But for him, for 15 portions, you have to take the stamp duty value of not the entire complex, only 15 portions proportionately, because not everything is given to me, right? Proportionately, that portion will be the full value of consideration for section 48. I keep repeating this section 48 because it is kind of important for our calculation or understanding also. When you do full value of consideration, you will take stamp duty value of the portion owned or eligible by the land owner, like 15 flats multiplied by stamp duty value, whatever it is. We have questions at the end of our sessions. We'll try to solve the questions also if the time permits. But whoever is watching, try to interact, guys. At least few more people will come and join. Okay, so that anyway I told you it is like a energy to me if people are coming and they are in participating. If few people are coming somewhere, we get disturbed. Even I was also thinking from that time, like why yesterday we had good, at least reasonable number of people who are watching our session. So Jacob is saying it's clear. Okay, thank you. Yeah. So next, capital gains. Okay. Okay. I don't know about that, but I will check on this, guys. Okay. So now hope now we got little clarity of that. Now capital gains on distribution of assets by companies in liquidation. So now a company is in the state of liquidation. Whenever they liquidate, what they do? A liquidator will be appointed. He'll be selling off all their assets in the market. He will realize the cash and he'll pay all our debts, outside liability, debentures, preference shareholders. Anything is pending, they will pay it to the equity shareholders. This we have studied in, intermediate level. We have chapter only, like how do you liquidate your assets, how do you liquidate the company. But now the question is, when the company, due to liquidation, they are not able to pay cash, but they are just giving the assets to the owners. Assuming that we are all shareholders in a company, the company is going well, but now we want, I'm coming, I can sell these assets in the market, remaining amount I can give it to all the owners of you. Or else what I can do, instead of giving selling off these assets in the market, I will distribute these assets only to you. Okay, so what in that situation, should the company be paying tax or should the recipient be paying tax is a question. This is very important. Somewhere they might ask for. So whoever is watching, pay attention and focus on this logic. You can expect 4 marks out of it. In the hands of the liquidated company, it is not taxable. The reason, they cannot pay tax now. So it is not taxable in the hands of the company when they are distributing the assets to the owners. But if the liquidator, instead of distributing to the owners, if he is selling off these assets in the market, he has to calculate the capital gain tax. I'll repeat. It's a balance sheet. We have a fixed asset 1, we have fixed asset 2, two fixed assets example. I am the liquidator. I am coming and selling off this asset in market. Okay. So full value of consideration, take an example 10 lakh and its cost of acquisition or index cost of acquisition 8 lakh. 2 lakh will be my short term or long term, as a case may be. Okay, depending upon whether that is a depreciable asset or non-depreciable assets, and period of holding also. 2 lakhs is my short term or long term. I have to pay tax on this. I have to pay capital gain tax. This is a second fixed asset 2. I am distributing it to owners. I am giving it to you only, right? Now, not taxable in the hands of company. Hope it is clear. I'm spending more time because it becomes a bit kind of a rocket science. Sometimes we don't understand. On liquidation, if the company is distributing the assets to the owners, company will not pay tax, shareholder will pay it. But if the company is selling in the open market, they will pay it. And there is another section 222C bolke that also will come into picture. We will see that in the income from other source chapter. Yeah. In the hands of the shareholder, whatever is the fair market value on the date when I am giving it to you, that will be your full value of consideration. Any question with respect to liquidation? 4 marks, it's like, yes, we are rushing and we are saying in 2-3 minutes, but there can be a question on this. Can someone answer? Is there any question with respect to liquidation of companies? Any clarity that you would require? Someone said maybe because of CMA results. It could be. I don't know. I'm not tracking when the results are out or when results are there. I'm not sure on that. Okay, any question with respect to liquidation of companies? When, who, why? Section 46A. Sorry, 46. 46A is a buyback. Okay, so here my example is, this is ABC Limited. Our balance sheet is having like this: fixed asset 1, one type of an asset, fixed asset 2, second type of an asset. They are having their own book values. I'm not revealing the numbers. Company wants to get liquidated. Now I am the liquidator. I'm coming to this company and I'm selling this FA1 in the market. I'm not giving it to you. I'm selling in the market. Okay. So when I'm selling in the market, maybe I'm selling it at example 10 lakh. The cost was 8 lakh. 2 lakhs ke upar I have to pay tax. I have to pay capital gain tax because it's a capital asset for me. This is clear. It is like general provision only. When a liquidator is selling an asset in the open market, it's a normal calculation, nothing to do with section 46. Now FA2, there is another set of assets. Instead of selling in the open market, I am just asking you, boss, you want to purchase because you are owners. If you take a call, you are like, no, we will only purchase. So I am distributing the assets on the date of liquidation to the owners. So I will not be paying tax. I will borrow the company. I will not be paying tax. Company will not be paying tax. The recipient, the shareholders, you will be paying tax. So it's a transfer for you, not for me. Okay. Hope it is clear. Sai. Okay, no doubt, sir. Thank you. Yeah. So that is your section 46. I am going little slowly, but because 4 marks is not a small number, people kind of get failed with 2 marks, 3 marks, aggregate number, something will go wrong, right? So even 1 mark also, we should be so rigid that I want to get it. Yeah. So now we'll go with the buyback of shares, section 46A. 46 was the liquidation, 46A is a buyback. In case of specified securities other than shares chargeable to tax in the hands of the holders of specified securities, as far as the shares are concerned, this provision would be attracted in the hands of the shareholder only if the shares are brought back by a company other than a domestic company. I'll give you the context, then you can understand. If it is a domestic company, Indian company, see ABC company, my company only, it's a domestic company. I am raising capital. You all invest money in my company. That's fine. Future me, what I am doing, I want to buy back my own shares. Like I want to, simple words. So I'm buying back my own shares and I'm the Indian company, right? So what I will do is I will only pay tax because obviously it should come into my hand only, right? So section 115 QA, I will be paying 20% plus 12% plus 4%, like surcharge, and says this is the amount I will be paying if the acquiring, like the company is a domestic company, they are purchasing or buying back shares from their shareholders. Maybe it's a listed or unlisted. If I'm not a domestic company, so which means that I am a non-resident or foreign company. So why you are asking a company to pay? Let the shareholder only pay. That is the reason why. If it is a other than this, only the specified securities may shareholder will be paying it. It will be taxable in the hands of the holder. I'll repeat because this is important. Again, you can expect 4 marks. It's either liquidation or here. If it is a domestic company, if they are buying back their own shares, be they are listed or be they are not listed, they will only pay the tax. Other than shares, other than domestic company, holder only will pay. Other than share also, holder only will pay. So this will give you a better picture. One more thing, because the domestic company is paying tax on their buyback of shares, it is exempt for you. I'll repeat, 115 QA, as per 115 QA, domestic company is paying tax on the buyback, like the amount I'm paying and amount you originally paid. Assuming that I'm issuing shares at 100 rupees, later I am buying back at 120. So the 20 rupees is there, no difference between the buyback price and the original issue price, 20 rupees. On that I will be calculating this 20 plus 12 plus 4%, that 23.96 something will come. Yeah, 23.296. So that is the amount I will only pay, because the company is paying, it is exempt in your hands. 1034A. Domestic company बोलते, company will pay, it is exempt for you. If it is other than the company, it is not taxable in the company, because company will not pay, so you will only pay because you are paying. Obviously there is nothing like exemption. Here also specified securities also, company will not pay, you will only pay it. Any question with respect to buyback? I will see, I know 4 or 5 people are at least serious. I'm okay as long as you are understanding and you are kind of participating. That gives me some energy to move ahead. Liquidation is done. Now buyback may anybody, any question, like this is not, little confusion is there here. Is there anything like that? Sai Krishna, hello. Hello. Any question with respect to buyback of shares? Clear? Yeah. So now section 57, transactions not regarded as a transfer. I'll just summarize what we have discussed. It's like a cumulative revision. First we started with what is specified securities. बोले तो anything other than your shares. It could be bonds, it could be debentures, it could be stock, anything. Okay, yeah. So first we started with what is a capital asset. We spend enough time on this, like when you call something as a capital asset, when exceptions, then when you call something as a transfer and exceptions, period of holding. Now what is not a transfer? So no, this is also important. The reason is that these are like exceptions to your taxability. You no need to tax now anything. You don't have to pay tax if you are falling under section 47. Distribution of total or partial partition of an HUF. HUF, you all know that family all families are always together. So family is always together and they are doing some business, but the company, the family has grown up and kids have grown up. They want to split it. They want to partition. It could be total partition. It can be partial partition. So whenever there is a partition of a HUF, it is not a transfer. Think practically. Where am I selling? Assuming that my father is having a big property, big business, all assumption how nice it is. Like we had a lot of family business, all assets, buildings and everything. Now my brother wants to start his own business, or he wants to take sites and I want to take my own sites. So we are splitting the family's business into different parts. But who is selling? Who is getting gain? Why you have to pay tax? So it's not a transfer only. Transfer under a gift or a will or irrevocable trust. So I'm giving you gift. Why should I pay capital gain tax? There's no sales price only, sales consideration only. I'll not be paying tax. But don't escape from this. Section 56 to under that section, the recipient, if the value is more than 50,000, he will pay tax under income from other source. But put it in from capital gain chapter, if it is a gift or a will or irrevocable trust, no transfer. See, someone is dying and is writing a will. Why are you asking him to pay tax? Is he selling anything? Is giving it to his family members or some good charity purpose. Transfer by a company to a subsidiary company. Okay, so there is X Limited, who is a holding company. Don't focus on my handwriting, guys. I'm not trying to write properly, but just make the information understandable. This is a subsidiary company. Now, holding company is transferring an asset to subsidiary company. Can that happen? Yes. My holding company is in Mumbai, subsidiary company is in Hyderabad. I need an asset, maybe a machinery. My holding company is giving it to me. Irrespective of what is the price I'm doing it, we are not doing the PGBP now. We are doing the capital gain chapter. Why should they pay tax? Because it is like a father is giving to son, right? That is not a transfer. But the condition is that it should be wholly owned holding company. बोले तो 100% of the capital of Y Limited should be held by the holding company. Like if I'm having 1 lakh shares, all 1 lakh shares should be held by the parent company. Then only this transaction is eligible. Otherwise, they have to pay because they are giving asset to me, right? It's a transfer. And the recipient is Y Limited, should be an Indian company. Always remember these two conditions. When holding company is giving to subsidiary company, holding company should be wholly owned company, holding company. And when holding is giving to subsidiary should be an Indian company. Take other way, holding company is in Mumbai, subsidiary company is in US. Mumbai say it is going to US. Now you cannot say that as per section 47 it's not a transfer. No, you have to calculate your capital gain now, doing some other calculation. Okay, if the transfer pricing is not accurate, you take any other price which is accurate to that, but you have to calculate it. Take other way. Subsidiary is giving it to holding company. Is it still a transfer? No, it is also not a transfer. See, holding company can give it to subsidiary company can also give it to holding company. Both are permissible, no applicant tax, but holding company should be wholly owned company plus the recipient company should be an Indian company. What do you mean by that? If from Hyderabad I am giving it to Mumbai, it's fine, but from Hyderabad if I am giving it to US and my holding company is in US, no, it is not. I cannot take a shelter under section 47 saying that it is not a transfer. It is a transfer. Any transfer by a subsidiary company to holding company, just now I said it, but remember the condition, the recipient, be it flowing from down to bottom or bottom to up, the recipient should be an Indian company and it should be, all the shares of the subsidiary should be held by the holding company. Any transfer by the amalgamating company to the amalgamated, same logic. Amalgamating company, like I'm X Limited, my shares like I am getting absorbed by Y Limited. Okay, so all assets will be taken by them, right? So is it a transfer? No, not a transfer, because there is a amalgamation, you can say absorption also. So all my assets are going to that company, right? So should I pay tax? Not required, but the condition is the amalgamated company, the like newborn baby should be an Indian company. It can be amalgamation, it can be demerger, any split will be fine, but the thing is that the resulting company, the amalgamated company should be an Indian company. Okay guys, any question with respect to these 3 points? Holding is giving to subsidiary or subsidiary is giving to holding, or amalgamated company is getting converted into amalgamated, and resulting demerged company is transferring it to resulting company. Just let me know quickly. Now another 2 real tough things are there to discuss. Okay, so next, any transfer by the amalgamating foreign company to amalgamated foreign company in a scheme of amalgamation of 2 foreign companies, meaning X Limited, we are in India, this is Y Limited, this is Vodafone case guys. Okay, if someone wants to understand, it's a Vodafone case, they fought it from years and years. This is in US, Z Limited, this is in UK. Okay, Now X Limited shares are held by Y Limited. Maybe a substantial share, not like 1 or 2, it's like assuming 10%. Okay. Now this is amalgamating company. They are getting amalgamated with YZ Limited. This is amalgamated company. Right. So now, because this company is getting amalgamated with this company Z Limited, obviously their assets are going to Y Limited. Right. So share is also an asset, right? So it is going to, sorry, Y Limited's assets are going to Z Limited. So should they pay tax in India? I mean, that is like a wildest of dream. You think that it is not, because the Y Limited is selling, is getting amalgamated with Z Limited. Both are foreign companies only. Both foreign companies are getting amalgamated, maybe demerger, maybe amalgamation. How does it matter? Because nothing is happening for us. Only some of our shares, our both the India's, some of our shares are held by Y Limited. So why are you calling it as a transfer? That was an issue. But what actually happening is, because they were having some shares in Indian company, so they are deriving the value of their shares or their valuation, their purchase consideration substantially for the shares they are holding in X Limited. X Limited లో షేర్స్ ఉన్నాయి కాబట్టి వాళ్ళ షేర్ వాల్యూ పెరిగింది కాబట్టి వాళ్ళు ఎక్కువ పర్చేస్ ప్రైస్ కన్సిడరేషన్ కి బార్గెన్ చేసుకున్నారు కాబట్టి దే ట్రాన్సాక్షన్, ద ట్రాన్సాక్షన్ బిట్వీన్ టూ ఫారెన్ కంపెనీ ఈజ్ derived or affected by the value of the assets that they had in our company or our country. కాబట్టి ఇట్స్ ఎ ట్రాన్స్ఫర్ అని అన్నాడు. కాకపోతే ఇది ఎగ్జామ్ట్, ఇట్స్ నాట్ ఎ ట్రాన్స్ఫర్. ఎప్పుడు రిలాక్సేషన్ ఇచ్చాడు ఇక్కడ, 25% of the shareholders of the amalgamating foreign company must continue to remain the shareholders of the amalgamated foreign company. ఈ Y లిమిటెడ్లో ఎంతైతే షేర్ క్యాపిటల్ ఉన్నారో అందులో 25% ఆఫ్ జనాలు షేర్ హోల్డర్స్ దే హ్యావ్ టు బీ కంటిన్యూయింగ్ విత్ ద Z Limited, at least 25%. Maybe everybody might not consent to the amalgamation, right? But at least 25% of the shareholders of the amalgamating foreign company should become the shareholders of the amalgamated foreign company. At least 25% anna undali. Okay. Such transfer should not attract capital gain in the country in which the amalgamating company is incorporated. Ante there should be no tax provision for this kind of a transaction in the country in which the amalgamating company has incorporated. Ante in US also there should be a relaxation for them whoever transfers shares outside. Ante manam vaniki oka benefit ichinappudu alanti benefit ante like నేను హెల్ప్ చేయాలనుకున్నప్పుడు కూడా నాకు హెల్ప్ చేసే మనస్తత్వం నీకు ఉండాలి కదా. సేమ్ వే అమాల్గమేటింగ్ ఫారెన్ కంపెనీ లో కూడా there has to be a provision, there has to be exemption from transfer, then only it is exempt in India. Means it is not a transfer in India. I should not be using the word exempt, but it is not a transfer in India. Any questions with respect to this, guys? It's a very tough topic, but I made it a reasonable effort to make it as simple as possible. Amalgamating foreign company is going to amalgamated foreign company, then it is not a transfer in India, provided there are two conditions. In examination they might be asking this question. Amalgamating foreign company 25% should become the shareholders of the amalgamated foreign company, and amalgamating foreign company, the company in country in which amalgamating foreign company has incorporated, there should be similar provisions like how we are giving in India, right? Any transfer in a demerger by the demerged company to the resulting company. So again this is also same thing, which just now I said. Reliance is a very big company, they often go for demerger. Any big companies, MNCs, you see they always hire like they merge with something or they acquire something and they spin off, split or demerger, they do it. Example, there is Reliance, big company. This may say they are becoming R1 one company, R2 another company. So this Reliance, you call it as a demerger. This is the resulting company, this is the resulting company, right? So obviously when there is a split of the big company, we distributing some assets to this one son, some assets to another son, right? Obviously. So whenever the transfer from the demerged company to the resulting company, it is not a transfer, provided the resulting company, this is a resulting company, right? Ante kottaga puttina company, the resulting company should be an Indian company, it should be incorporated in India, which means Adani unnadu, if you want, if he's what do you call it, if he is doing any demerger of the companies and incorporating one company in UK example or Canada, he cannot say that okay, there is not a transfer. If he really wants to do that, let the new forming companies be incorporated in India. ఇండియాలోనే మనదే కాబట్టి ఓకే, మన దగ్గర నుంచి బయటికి పోతే కాదు. ఓకే, ద రిజల్టింగ్ కంపెనీ షుడ్ బి అన్ ఇండియన్ కంపెనీ. మన వాళ్ళు అలా ఆలోచిస్తారు. ఓకే, ఎనీ ట్రాన్స్ఫర్ బై ద డిమర్జ్డ్ ఫారెన్ కంపెనీ టు ద రిజల్టింగ్ ఫారెన్ కంపెనీ ఇన్ ఎ స్కీమ్ ఆఫ్ డిమర్జర్. ఇందాక చెప్పిన సేమ్ ప్రొవిజన్ని రివర్స్ చేసి చెప్తాను. X Limited, this is the India company, it's an Indian company. This is in US, so you know it's a foreign company. So they are holding some shares in Indian company, so means they are deriving their value from the shares they are holding in India. This is also clear. Now this company is becoming splitting into two parts. Okay, resulting R1, R2. Okay, R1 is an Indian company. Because of demerger, they are giving birth to two new companies, and this R2 is U or Canada, will say. So some assets they will transfer it to R1, some assets they will transfer it to R2. So now the question is, do you call this is a transfer, this is not, or this is not a transfer? The easiest way of saying is, from Y Limited, at least 3/4 of the people should continue be the shareholders of the resulting company, plus the resulting company should be an Indian company. If these two conditions are cumulatively satisfied, then it's not a transfer. It's a very rare that you expect examination questions on this, but just for our understanding and for future purpose, we need to understand these provisions. And few more things, it is less important, but I'm still telling you, maybe if the examiner wants to twist you more. Global depository research you might have heard, which means that our NRI people, they will purchase some shares in Indian company, not directly, through global depository research. We will convert a few shares into a bucket list, and that bucket is bought by them. It's like global depository research, which means across the world there are multiple currencies, multiple regulations, right? So they cannot directly invest in India in Indian rupees. So what we do is we will convert our Indian shares of a pool and a bucket into a global depository receipt, which means that this receipt can be bought and sold by any foreign, because it is traded in the foreign currency. So now the question is, when this global depository receipts, when someone is selling from one party to another party in foreign currency, it is also not a transfer. Rupee denominated bonds, also same logic. I'm not explaining much on this, I don't want you to get confused also. And there are certain institutions like International Financial Service Center. Here also there is even if you are dealing with the transfer of specified cash shares, because it is dealt by the non-residents and they do it in their own foreign currency, that is the reason why it's not a transfer. You need not pay tax on this. Okay, gold sovereign bonds, gold security bonds, bullion, all these things are not a transfers. Now this is important at an intermediate level especially. So you have something as a capital asset, but you are not selling it to anyone, you are giving it to government. Like you drawn something, some archaeological collections, instead of selling it to someone else, you are giving it for future reference. Okay, so it's not a transfer. You are giving it to university, national museum, national art gallery, national archives, any other public museum or institution notified by the government. What you are giving work of art, archaeological or scientific collection, books, manuscript, drawings, paintings, photography, paint. So these things, if you are giving it to all these people, then it's not a transfer. No need to buy hard anything, guys, just understand, if you're giving to these people, not a transfer. And conversion from bonds to debentures or debenture stocks or deposit certificates of any form, being bonds or debentures. You might have heard this convertible debentures will issue at CPT or foundation level. We might have studied this. I'm issuing a debenture, I will convert it in future. So convertible debentures, convertible bonds, convertible preference shares. So I will give you a form of a instrument. At some point of time, if I want, I will issue, I will convert this bond into equity. Okay, it can be my option, it can be your option. That will be financial instrument chapter at CA final level. But for now, I'm issuing an instrument. That instrument can get converted into another form. So if it is getting converted, it's not a transfer. Just like I have a capital asset, at some point of time, capital asset I'm getting converted into stock in trade. Where am I selling? Not selling, right? So it's not a transfer. Same logic. I am issuing a bond. At some point of time, I'm converting into equity. Who is giving cash? Who is receiving cash? Where is the transaction? It's not a transfer. Same thing I just explained. Preference shares converted to equity shares, also same thing. And SIC industries also, there is one small provision. 1 mark ke liye it might come. SIC industries, although you know it as per there is one act only. Companies or factories, especially MSMEs, like who are really into depression, brother, financial depression. They're not having cash to pay for their employees, and their net worth has eroded, and they lost continuously over a period of time. So at that time, because of survival issue, they are selling off certain their assets. It's not that they are selling it at a profit. They are selling it to make some profit. They are selling it to survive, right? So if such SIC industries, which has declared as a SIC as per the SIC Industrial Act, will not go into that detail. If it is declared as a SIC as per that act, and that industries or the factory is selling some of its assets to survive, then it's not a transfer. Then they need not pay capital gain tax on that. Reverse mortgage, this one example. Go for a business loan. Okay, I want 1 crore rupees for starting a business. I have a building in my name. So what I do, I go to a bank and I'll tell the bank that, boss, I required 1 crore. You take this land or the building which I own as a mortgage. I continue to, you first pay me the 1 crore now. I'll continue to pay you the EMIs, installments, over a period of 20 years. Let's say that example. This is very clear, right? This is a normal mortgage. But for senior citizens who spend all their life in saving the money and constructing a building or buying a home, at the fag end of their life, I mean, once they get retired, they won't be having cash to survive, and they have to depend on their kids and grandkids, and sometimes kids and grandkids also, they don't support them as much as they needed. So for those people, what they do is, they also, like very painful situations, very emotional situation, they also go to the bank and they say that, for survival I require 50,000 rupees per month. You keep paying me 50,000 rupees per month till I survive, and I keep my building as a mortgage. You keep paying me for my medical expenses, whatever you pay me, 50,000 rupees per month. When I die, take this property and sell it off in the open market, and remaining amount, whatever is left over, you pay to my kids or grandkids. Or if they don't want you to sell it, whatever the outstanding amount, you take from them and you release the mortgage. So that is the reason why it is called reverse mortgage. Generally what happens for me when I'm starting a business, I'm taking the loan upfront and paying the EMI, right? In reverse mortgage, that old man or retired person is taking the money upfront, and their kids or grandkids, they are repaying that to the bank in lump sum. So that is the reason why it is called reverse mortgage, and it's a very pathetic situation that we are in. We don't want to we don't want to burden that person with again capital gain tax. There is no capital gain बोल के government came up with this explanation. I hope that is clear. I'm giving you the background of what you call something as a reverse mortgage and why it is not taxable. Okay. And special purpose vehicle, business trust, InvITs, these are all at a final level. Like there are certain trust. What they do is they create a special purpose vehicle, they invest the money there, and that person, that special purpose vehicle will eventually invest in investment properties or something like that. Okay, so instead of directly me doing the business, I will create a special purpose vehicle only for some purpose, constructing the buildings or for mutual funds or something like that. So they will eventually pay back money, everything to me only. So here also there is no transfer. Okay, this section is saying. Any questions with respect to what is not a transfer, guys? I know it might be a bit boring for you, but my jidd is that I don't want to miss anything. It's okay, we can spend 1 more hour, but in examination when something comes, we are sure of what they are saying and what we are writing. You know, instead of rushing the entire session into 1 hour quickly or 2 hour quickly, we'll spend 3 hours, but we hopefully cover every bit of the portion. Is it clear, guys? Only few people are responding. Jacob is responding. Okay. Okay, so that is your section 47. What I have discussed so far is not a transfer. Now we'll go to a few more things. Transfer of a capital asset or intangible asset on succession of a firm by a company or AOP or BOI to a company consequent to demutualization or corporatization of a recognized stock exchange. Okay, whatever it is. But now the question is, you are having a firm or AOP or BOI. See, this used to be the long time back, but we can use the same provisions for anything. You are having a firm, you are having a AOP, or you are having a BOI. Okay. So now this AOP, BOI is getting, or firm getting converted into a company. So by now we are in a stage to say that in AOP, BOI we only have members or partners. Members in AOP, BOI we call members, but for partners we'll say, for firm we'll say only partners. Okay, they get converted into company, right? So obviously they would have their own balance sheet. In that balance sheet they would be having their own assets. These assets, they are in the name of the AOP or they are in the name of BOI. They are all getting converted or they are transferring it to company. So is it a transfer? Is it not a transfer? They are saying it is not a transfer, but I will be giving you 5 conditions. You fulfill all these conditions, then we can say there is no transfer. You don't need to pay. You bole to firm need not pay tax on that. All assets and liabilities before the succession should become the assets and liabilities of the company. Means in their balance sheet, whatever the assets are there, whatever the liabilities are there, everything should go to the company. It is not like you are having 20 assets, example. One asset you are giving to one company, another asset you are giving to one company. So it's like a sale of an asset. See, in India's 103 business combination, it is CA final level. I think CMA final level also you will have it this. So it is not like you are selling a business, you are selling an asset, right? Selling an asset is different from selling a business. So they are saying if your intention is really to get converted from a firm to a company, all the assets, all the liabilities should go to the company. All the partners of the firm immediately before the succession should become the shareholders of the company. We'll take an example. There is a firm. Okay, they are having A, B, C, D. They are partners. Each is contributing 5 lakh. 5 lakh capital I am talking about. 5 lakh. 5 lakh. So 25% each. Okay. So now what they are saying is all the assets and liabilities immediately before the succession of the firm should become the assets and liabilities of the company. This is very clear. Second thing, all the partners, whoever is staying there, should become the members of the company, not all. Okay, all, but their stake should be at least 50%. What do you mean by that? Now how much it is becoming? 20 lakh raise their capital. In company, they will have their capital. So capital में assuming they are raising 40 lakh. So 20 lakhs they can raise it from the existing partners, from these people. Remaining 20 lakhs they can go it for the outside investors. These are all old partners. Sir, why are you saying only 20, not why in any other proportion? Because if I am giving 20 lakhs to my existing partners, which means out of 40 I am giving 20 बोले तो 50%. So their stake, the shareholder, the partners' stake in the company should not be less than 50%. Means when the company is raising new capital, they cannot raise so much of capital like how much ever they want it. It is not a genuine transaction. If it has to be a genuine transaction, they have to raise exactly the same amount they are having as a partners, which means partners, they are having 20 lakhs, right? So 20 lakhs anyway you have to give it to these partners as a shareholding or shares. Remaining 20 lakhs they can raise it from the public. If they want, they can raise. If they don't want, they don't raise it. But don't make this proportion of partners holding in the company less than 50%. So hypothetically 20 lakhs you are raising it from your partners and 25 lakhs you are raising it from your external investors, which means their stake will be lesser than 50, maybe 45, 46. So you are violating this condition. Okay. Next, they don't receive any other consideration. Consideration, why should you give anything to them? You only offer shares in the company, don't offer anything else. And they should have 50% stake voting rights in the company, and that should be there for the continuous period of 5 years. Like in 2023 you are getting converted into the company, right? From today till 2028 tak, this partner's stake in the company should be 50%. It should not go below 50% for the next 5 years. Okay. And it should be as per as SEBI if it is a demutualization and corporatization. Any question, guys, with respect to this? Any question? Sir, why are you teaching all this? Bolke don't say. We don't know when question comes and how the question comes. See, once you understand this, no, there is again shareholder. See, now what we have done, from firm or AOP or BOI, we are converting into company, right? Now the provisions will be from company, they get converted into LLP because they don't want so many procedural things which are there for the company. LLP, the limited compliances will be there. Once you understand one point, everything is a replica, just copy paste with the change in the words. All the assets and liabilities of the company should become all the assets and liabilities of the LLP. All the shareholders of the company should become LLP. बोला तो don't say the word shareholders, say the word partners in that company, and they should not receive any other consideration other than the capital contribution. Don't say shareholding, they will use the word capital. Okay, partners LLP बोले तो, and they should have 50%. Same logic. Company is having example will take. Company having 10 lakh shares, no? There would be lot of shareholders, we don't know. But usme se 50% should be partners of the LLP. Just like from AOP to BOI firm to company, said 50% should move there. I'm not 50% in value, I'm saying 50% they should have the holding. Here also 50% voting rights, shareholders should become the partners in the LLP, and they should hold 50% of the LLPs, and it should continue for next 5 years. And no amount is paid, so indirectly you should not see company bolta, you'll have a lot of reserves. Okay, once you get converted into LLP, don't bring on any other consideration to them. For next 3 years there should not be utilization of your funds between the partners. I hope this is also clear, because once you understood this original one, this is also same. Okay, so now we will go to the section 47 is like all exemptions. I know, not transfer. You should not use the word exemptions. All the transactions which are not regarded as a transfer. Okay. Now 47A is that I told amalgamating company is becoming amalgamated company. Assets from amalgamating is going to amalgamated, or demerger to resulting company, holding to subsidiary, subsidiary to holding, gifted to, that's all fine. But the resulting company, the recipient, should hold that asset for next 8 years. If there is any violation of this provision, then the transferor should need to pay tax on this. So you might get a doubt, sir, if it is an amalgamating company that is already dead, no, then how come it will be paid? Who will be paying? So the recipient will pay in that circumstances. And section 48, you know this thing, for short term capital asset ke liye you will have sale consideration, transfer expenses which are important, and you have net consideration, and you have cost of acquisition or cost of improvement, and you will have short term capital gain or short term capital loss for short term capital loss. If it is a long term capital asset, so this is the section 48. Long term capital gain or long term capital loss. Anyway, you have section 54 ka deduction also. So once you take that section 54 EC tak, you will have G also, you have G, GA, GB also we have. So 54 deductions, whatever deductions are there, that you will take it. Now that will be your taxable short term capital gain or short term capital. And whenever you are calculating the long term capital asset, you will be using the indexation. Indexation is like you are bringing your original cost to present terms. So I'm not giving the big formula. In examination, what you can write is cost of acquisition CII in the year in which the transfer is taking place divided by CII in the year in which the asset is first held by the assessee, which means the date of purchase. In simple language, cost of acquisition multiplied by CII, okay, of the year in which the transfer is taking place divided by CII of the year in which the asset is held by you or purchased. Okay, if you are purchasing the date when you acquired it, like for that financial year, whatever is the CII, and if it is held by someone else, you see when it was held. And again, if it is held, if you buy it before 1st April 2001, you have an option of taking cost or fair market value, whichever is higher, because you will want to take more so that your cost will become more and your tax will become less, right? So that option is there. We will discuss more into it, but for time being, CII is required only for a long term. Indexation will not be applicable for non-resident. They will not be taking this benefit. And for depreciable assets, you will not take the indexation benefit. For slump sale also, you will not take the depreciation, slump sale calculation also, you will not take the effect of the indexation. This is important from examination perspective. So now for 2022 and 23, the rate is 331. This is the only thing you remember in examination. Everything else will be given in the question only. Originally 2021 to 22, 2001 to 100 was a base. Earlier it used to be 1st April 1981. They amended like 2-3 years back and they made it 2001 to 2. It is 100. So there are certain special provisions for non-residents. The special provision is that if a non-resident is making an investment in India, they would be making investment first initially in US dollars. So from US dollars, he'll convert the money into Indian rupees, and then he'll make an investment in Indian instruments, financial instrument, whatever it may be. Whenever he wants to sell, what he will do? He'll sell this instrument and he'll take the money in his own currency and will leave. We have given a format. This is absolutely necessary. You might expect a question on this. Okay, so it can be 4 to 5 marks question. You can expect. When I'm selling my instrument, sale consideration. When I have to sell my instrument, I have to incur some cost like transfer expenditure, sale consideration, cost transfer expenditure, and when I'm purchasing, cost of acquisition. Everything is incurred in India, right? Everything is incurred in India. So all these three has to be converted into his own currency in which he originally used. What do you mean by that? If someone is making an investment from Australian dollars, like Australia, he would have used Australian dollars, right? So I have to convert sale consideration, transfer price, transfer expenses, cost of acquisition into Australian dollars by using a conversion rate. Now you say rate is 84 rupees or 86 rupees, like that is the rates are there, no? Don't the random rate that is given by TTBR, TTSR, telegraphic transfer buying rate and telegraphic transfer selling rate. So you take the average rate for these three: cost of acquisition, selling price and expenditure. These three ke liye you convert this back to the currency in which he originally bought it by using average rate of TTBR and TTSR. So now what has happened? All the things are gone to his own currency. Now you calculate the capital gain. Once you calculate the capital gain, because you have everything in his own currency, whatever the gain that he eventually gets, that you convert back to Indian rupees by using TTBR. TTBR buying rate you will be using. So this is absolutely important, guys. I'll give you one random example. Someone is using $100 to make an investment in India. So maybe at that time he might have purchased it for 80 rupees assumption. Okay, so 8,000 is Indian rupee now. With this 8,000 he might have purchased some instruments or securities in India. So cost of acquisition, you know, with the 8,000 only, maybe some expenditure here and there. Just cost of acquisition is making an investment in India. He's holding it for 36 months, let's take an example, and then he's making a sale. So sales consideration, while making a sale, he might have been incurring some cost. So that cost of transfer expenditure, all these amounts, don't use the rate that he used it. He might have used it, don't use that. All the three, you use it TTBR plus TTSR divided by 2. Assumption 88 plus 89 divided by 2. So 88.5. So this amount you convert back, I mean like cost of acquisition separately, sale consideration separately, transfer expenses separately. You convert it by using the 88.50. You will get the amount in dollars, and then the dollars convert back to Indian rupees by using TTBR. Okay, why is this so much of complexity? India wants to have little advantage in that, so they are not using average, because our average is obviously lesser amount, buying rate is again a good amount. Okay, so that is a format they have given. We need to use this. And the benefit of indexation and foreign fluctuations, like whatever I said, is not applicable for equity shares which are on which you are paying STT. The reason is that they are taxed at a different rate. You don't have to use this indexation benefit there. Directly, whatever the period, you will be using it directly. Okay, so now I'll just repeat what we have done so far. We have started with capital asset, transfer, period of holding, then what is not a transfer, section 47, then we are going to 49, what is the cost in certain specified cases. So these sections are really important for this chapter. Why this is important? Sometimes you don't know what is your cost. How do I don't know, sir? See, whatever we discussed in section 47, you remember what is not a transfer. I'm giving you as a gift, not a transfer. Partition of HUF, not a transfer. Amalgamating to amalgamated company, not a transfer. Conversion, not a transfer. There are so many cases. I said it. Bond is getting converted into 5 equity shares. It's a conversion. Conversion, is it a transfer? I said it's not a transfer. Okay. The bond is getting converted into equity shares. It's not a transfer as per section 47. Clear. But these shares eventually you sell it in, maybe subsequently after 2-3 years you'll sell it, right? So when you sell, as per section 48, you know what is your sale consideration, you know what is your transfer expenditure, you know what is your net consideration. Then what is your cost of acquisition? What is your cost? Because you didn't purchase shares, you bought bonds, right? So the cost for this equity shares should be the cost of the bonds. Whenever there is a conversion, cost of the bonds will be the cost for equity. I'm just giving like that. Whenever there is not a transfer, we discussed in section 47, right? All those things we will discuss in section 49 by saying whatever is the cost to the previous owner will be costed to you, like partition of HUF, gift, will, succession, or distribution on liquidation, and revocation of trust, holding company is giving to subsidiary company having 100% stake, amalgamating company is giving to amalgamated company, demerged company is giving to resulting company, amalgamating foreign company is giving to amalgamated foreign company. So all these things costed to the previous owner, you will be considering it. So this is important, guys, and because I know people will be watching from our own states, Telangana and Andhra Pradesh. So the amendment మన కోసమే జరిగింది. ఇది అమెండ్మెంట్ మన కోసమే జరిగింది అంటే బికాస్ ఆఫ్ రీఆర్గనైజేషన్ ఆఫ్ ద స్టేట్. అమరావతి స్టేట్ని కడతప్పుడు లైక్ దే హ్యావ్ టేకెన్ ద ల్యాండ్ పూలింగ్, లైక్ ల్యాండ్ ఫ్రమ్ ద ఫార్మర్స్, రైట్? సో ఈజ్ ఇట్ ఏ ట్రాన్స్ఫర్, ఈజ్ ఇట్ నాట్ ఏ ట్రాన్స్ఫర్? We have a big discussion. It can take 1 or 2 hours entirely, but in a short ga cheppali ante, in the previous year in which you are making a transfer to the government, if you are selling it before 2 years, okay, it's not a transfer. If you are selling after the end of 2 years from the date in which, from the previous year in which you made a transfer, it is taxable. Okay, adi inka explanation lo cheptanu. So 2nd June, you might be knowing this date. On this date, the act has come into effect or the state has been formed. Transferring under the land pooling scheme of AP, it is exempt under section 1037A. Ante farmers, when they are giving their land to the government, it is exempt. Konni conditions lalla Hello. Hello. Hello, can someone confirm if my voice is clear or not clear? Hello. Hello guys, can someone confirm if my voice? Guys, can someone confirm? I don't know, I'm using same settings as okay. I'll continue. Let's see how it comes. Yeah, so what I'm saying is I think whole explanation has gone wasted now. Okay, so my point was, if the government has compulsorily acquired your property, it is a transfer, but because it is causing unnecessary pain, at the same time it's an agricultural land, it is taken from the far off places, right? It's not in a specified area, it is exempt. But thing is that, see, assuming that I am the government now, you are the farmer, I'm taking your property and I'm giving you cash, exempt, that's it. I'm taking your land and I'm giving you a right, okay, and that right you are selling it now only within 2 years, still exempt. But if you are holding that right beyond 2 years from the end of the financial year in which I'm giving you a right, then it is taxable. Okay, that's what they are saying. Transfer of constituted plot or land after 2 years from the end of the previous year in which he receives the possession subjected to capital gain. Okay, so now I'll take with an example, guys. 2nd June 2014, this provision has come into effect. Let's take an example. 1st July 2014, government has compulsorily acquired your land. Okay, so you are Mr. X, compulsorily acquired land. We'll go with case by case. Case 1, government is paying you cash, government is paying you cash, then that is exempt under section 1037A. Clear? Now case 2, they are giving you license, I mean like right in the property. Okay, license that you are selling before 2 years. How do you calculate 2 years? End of the financial year is 31st March 2015 plus 2 years बोले तो 31st March 2017. You are selling the right that is given to you by the government by 31st March 2017. మంచోన్ వే 2 yearsలో పెద్దగా ఏం డెవలప్మెంట్ ఏం జరగలేదు ఆ ల్యాండ్కి, అంటే దట్ ఈస్ ద ఇంటెన్షన్ బిహైండ్ ఇట్. నథింగ్ హ్యాస్ గాన్, నథింగ్ హ్యాస్ బిన్ డన్ ఫర్ దట్ ల్యాండ్ ఇన్ 2 years. సో స్టిల్ it is exempt under section 1037A, but you are selling that right on or after 1st April 2017, but after any date. Maybe there could be some farmers who got the right from the government which they have not yet sold, now they want to sell it now. Then whatever the price that they sell it, that is a full sale consideration minus transfer expenditure, full value of consideration. Cost of acquisition will be the fair market value on the date, like 31st March 2017, whatever is the value, that will be their cost of acquisition. Just let me know guys if the concept is clear, because the concept is very tricky and like it takes some time to understand. I'll just take a minute and I'll have some water also. Now tell me, is there any doubt with respect to this concept? At least one person tell me if there is any question, because you can expect at least one MCQ bits, maybe a 4 marker straight away. Anyone? ఏ పోండి సార్ ఎన్నిసార్లు అడుగుతారంటారా? ఓకే, దట్ ఈస్ యువర్ 1037A. ఓకే, now we'll go to the cost of acquisition of intangibles. Tangibles though you have understood, whatever you paid, that is your cost of acquisition. If it is received from any transaction as said in section 14(9), cost to the previous owner is the cost to you, that you understood. If the same is acquired before 1st April 2001, you have an option to take the cost or fair market value, whichever is more or whichever is beneficial to you, you can take that way. Yeah, so for intangibles, anything that you are purchasing, it's a purchase price. Like see, intangibles ante pratisar don't think it's only goodwill. You have patent, copyright, trademarks, loom horse, trademarks. There are so many things, I don't remember the names also. So many trademarks are there, intangibles are there. If you are purchasing from someone else, whatever the price that you are paying, that is your purchase price, that will be the cost of acquisition. No doubt about it. But coming to goodwill, I think this explanation I have given for PGBP also. If you have goodwill in your block, because government stopped or the income tax stopped giving depreciation on the goodwill, right? Like that. Earlier, if you had goodwill in your block of intangible asset, you separate that from the entire block. Goodwill is separate cheyandi, and what was the original cost you bought it, maybe 5 years back you bought it for 1 lakh, and if that was the only standalone intangible asset for your block, what would have been the depreciation you charge it on a year-on-year basis till 1920? Okay, that will be the cost now. Eventually, if you bought it 3 years back, okay, I'll take the random numbers. You bought it for 1 lakh. First year you are charged 25,000, so it will be 75 may again 25%. Okay, so another 15,000 next year. Don't go with the numbers, just a calculation. Second year 15,000, third year 10,000. Okay, so now 25, 30, 40, 50. So 50,000 is the WDV, notional WDV. Had goodwill was the only asset of your intangible in your bucket or in your block of assets. So 50,000, eventually if you are selling it for 80,000, example, 30,000 will be your short-term capital gain, or if you are selling it for 40,000, 10,000 will be short-term capital loss. Let me repeat, if you have a lot of intangibles which includes goodwill also, you have to calculate that goodwill portion separately from retrospectively, from initial acquisition. If that was the only asset, what would have been the cost? You know what is the cost. You keep calculating depreciation for year-on-year basis till 1920, because that is the last year for which you are eligible for depreciation on the goodwill, and depreciation for the goodwill, and that will be your cost. And in case of circumstances mentioned in section 49(1), it can be like amalgamating companies giving good intangible to amalgamated company, holding companies giving to, like, there are in section 49 you have big list, right? Whatever is the cost of the previous owner, that will be the cost to you. And if it is a self-generated goodwill, it will be nil. It will be nil. You cannot have a goodwill that you think you are having. Okay, it should be purchased from someone else. Okay, otherwise everybody will say that I have a goodwill. I can also say that I have goodwill because my subscribers are like that, but in fact that is not a goodwill. Okay, if I am purchasing it from someone else, then it's a goodwill. So same thing they explained, self-generated goodwill mein the value will be nil. If you are purchasing from someone, whatever the money that you pay, that will be the thing. Depreciation ke liye I told you do it separately as if that was a sole asset. And if you are getting it from your previous owners, like a partition of HUF, gift, will, irrevocable trust, whatever the cost of the previous owner, that will be the cost to you. In case of bonus shares, guys, nobody is at least responding to say whether you're understanding, not understanding, going fast, nothing. Any questions so far with respect to this intangible? So far we have bonus shares, right shares. You can expect a 5-mark question from either of these, or maybe combination of both. Okay, I will start that, but just at least few people say whether it is clear or not. Okay, anyway, I'll continue. See, for bonus shares, like free shares, bonus shares ka matlab it's a free share. If you are receiving bonus share prior to 1st April 2001, because that is a base year for your indexation, we had a provision that if you are acquiring any asset before this date, you have an option of taking cost or fair market value, whichever is beneficial to you, which is in a literal sense we should not be using it for bonus shares, but that is a misinterpretation of the law, or you can say misuse of the law. See, bonus shares bolte you are getting it for free. Where is the cost involved? We are taking it before 1st April 2001 or after that, it should be 0 only, but because we make advantage or take advantage of the words given in the section, you have an option to take either cost or fair market value on that particular day, whichever is higher. But if it is post that and before first, yeah, so if the bonus shares are allotted before this date, then you have to do like this: actual cost of acquisition, obviously nil. And if you are purchasing it, if the bonus shares were given to you before 1st April 2001, fair market value, see, I'll put it this way: 1st April 2001. A company, take an example, Tata, that's an old company, right? My age is not that. We'll talk about someone like 60 years, my dad age. Okay, so he had 100 shares in that Tata company. Tata company has given bonus shares to him in year 2000. Okay, so he acquired it before this. Then you can say, what is your cost for your bonus shares? What is your cost boleto? Actual cost or fair market value. Actual cost is always 0, fair market value may be 10 example. So I can take 10 as my cost of acquisition with respect to bonus shares. Now first Feb 2018 there is an amendment. The amendment is like that your cost should not be more than the fair market value on this particular day, 31st Jan, like one day before the amendment. So if you are purchasing between these two periods, this will be the actual cost, that will be nil, and you don't have a fair market value option, so it will be 0 only. So their thinking is it should not be more than the fair market value as on one day before the amendment. So 31st Jan 2018. So least of these three will be your cost. We'll do with the numbers if you still not understand. The formula is given like this: higher of actual cost, lower of fair market value or actual consideration. So lower of fair market value on 31st Jan 2018, or when you are selling, what is your cost, what is your sales price. So lower of these two, compare it to with the what is your actual cost. Okay, so higher of these two, higher of first, then lower of fair market value on 31st Jan 2018 or your actual sale consideration. Okay, with numbers you will understand better, but let's move forward. Next, right shares. This is very important in examination. You can expect this. I'm the company, you are holding one share in my company. Example, I'm giving you 1:1 share. Okay, so market mein the price is 100, I want to give you it at 90 rupees only. So if you want to purchase, you purchase it. What is your cost also? 90, because that's what you are paying it to me. That is case number 1. Case number 2, you don't want to purchase, but you don't want to get it lapsed also. You want to sell this right to someone else. That is called renouncing the right. So when you are renouncing the right to someone else, the person might pay you 5 rupees. So that person will pay you 5 and he will get the right and he'll purchase it from me. So for him, what is the cost also? 5 rupees what he paid to you, 90 rupees what he paid to me. So 95 is his cost. Okay, for you, what is the cost? 90 rupees is the cost if you are purchasing directly. Okay, so that's what they say. If you are not renouncing anyone and directly you are only paying, whatever you paid to me, that will be your cost of acquisition. But if you are renouncing, you don't pay, you are getting it for free. That is your cost will be 0 and you are giving it to someone else for 5 rupees, right? 5 minus 0, that will be your short term capital gain. And the one who is purchasing, his cost will be 5, like the renounce price plus actual price. 95 will be his cost. So purchase price plus renounce entitlement price. You on this you will find illustrations, guys. Illustrations we will do it if time permits. Otherwise you can also do it. But understand the concept. Who is from whose point of view we are checking. This I explained, so I don't want to get into this again. Any other capital asset, I said if it is acquired before 1st April 2001, cost or fair market value on that particular date, whichever is more beneficial to you, but that should not exceed stamp duty value. This is a latest amendment. I don't think it's not last year only, but I think 2-3 years back. The earlier provision was only cost of acquisition or fair market value on the date of 1st April 2001, whichever is more beneficial. But now they said that time fair market value also should not be more than your stamp duty value. Unnecessarily they are bringing stamp duty value into your fair market value calculations. Okay, we have few questions. Let's see. I think 10 people have joined here. Now let's see how many of you can answer. I think at least 2-3 people are answering. I will not be revealing the answer straight away. I would request everyone to make an effort and solve it in your book, not very neatly, but randomly you do it with a calculator and tell me the answer. We'll compare. Then we can know that, sir, yes sir, today by attending 2-hour session I understood capital gain. Otherwise it is just like any other video that you watch on YouTube, and you will get more benefit from watching those videos. But I'm saying here our more main motive is to get the application part. I will read it and I'll wait for a minute. Well, let's see whoever answers it. At least 2-3 people are there who are serious. No, let's check for them if they can do. Bring your calculator, bring your own device. ABC Limited converts its share capital as acquired for an amount of 50,000 in Jan 2003 into stock in trade in the month of November 2019. The fair market value of the asset on the date is 4.5 lakh. The stock in trade was sold for an amount of 6.5 lakh in the month of September. What will be the tax treatment? See, CII for the new questions in examination, they will be giving it for the next year, but don't get confused. It's okay. Old rates are given. We'll do with that only, but concept is same, right? So I'll just give a timeline. 2003 Jan May acquired capital asset. November 2019 May capital asset you are converting into stock in trade on that date when the fair market value was 4.5 lakh. You apply all the provisions on conversion. Is it transfer? Yes, it's transfer, but will not pay tax there. Eventually it is sold in September 2021, sold for 6.5 lakh. Now tell me, what is the chargeable under capital gain? What is chargeable under PGBP? I'll wait for a minute because that's the time I get some break also, but take it like a challenge, guys. If it comes for 3 marks or 4 marks, I will be doing it. Let's do it. Not just one question, we have a lot of questions. I could have skipped this question, but the only point is that it will make you apply the provision. చాలా రఫ్గా అయినా పర్లేదు, బట్ న్యూమరికల్ అక్యురసీ షుడ్ బి దేర్. ఓకే, దిస్ ఈస్ వాట్ ఐ కెప్ట్ టెలింగ్ ఇన్ ఆల్ మై వీడియోస్. డిటి, ఐడిటి, కాస్టింగ్, అకౌంట్స్ ఎఫ్ఎం. Accounts FM, you know it, right? Costing, accounts FM and all. But DT, IDT, lot of people focus on the provisions. That's good. But coming to numbers, they make a lot of effort, mistakes, and that will cost you marks. If you write with a very good language, but application may you make mistakes in calculation, valuation. No, that will not help valuer in deciding how good you are with the subject. రాయడం కొంచెం యావరేజ్ రాసినా పర్లేదు, నంబర్స్ మాత్రం 100% అక్యురసీ రావాలి. ఇన్ డిటి ఆల్సో ఇట్ ఈస్ రియలీ స్కోరింగ్ ఇఫ్ యూ అండర్స్టాండ్ దిస్ వన్ లాజిక్. అప్లికేషన్ దగ్గర మీకు ఎంత కంటెంట్ ఉంది, ఎంత దమ్ము ఉంది, అది మ్యాటర్స్. ఫాస్ట్ రివిజన్ వీడియోస్ని చూస్తాను, 10 సార్లు చూసినా చూస్తావు బాగుంది అంటావు అంతే. బట్ ఇన్ రియాలిటీ హౌ యు ఆర్ అప్లయింగ్, దట్ ఈస్ మోర్ ఇంపార్టెంట్, రైట్? Yes, Jacob, I will give you. As I said, if you are ready to solve, I am here to solve all the questions, all the answers. It is more about your participation, more about your encouragement. It can be 5-hour session also, it's fine. But there should be so much of participation and involvement, the energy, everything should come, okay? If someone is ready to listen, I am always ready to teach. So if anybody is joining now, this is the question I'm giving it to you. Please solve it in your book and let me know the answer. you take the FIIs or CII number given in the question only, it's fine. In examination, I'm sure you will take the new numbers. Yes, someone just said no. Results have come correct. Few people are posting. Guys, who will be solving this question and who are doing it, just continue doing it. I'm saying the ones who are joining now. So once who are joining, just let me know what is your answer. The sessions are more towards application of your concepts rather than just covering the provisions in a very fast way. So PGBP, Jacob is saying 44 lakh, 4 lakh capital gain. I would say wrong, Jacob. See, for PGBP, it is a stock in trade from, you know, their selling price is 6.5 lakh. Their cost of acquisition, you should not say cost, it's just COGS. Cost is 4.5 lakh. They bought it for 50,000. So difference between these two values will become capital gain with indexation. You have to do it. Difference between these two will become your business income. See, 2 lakh, that's what I said it. 2 lakhs will become your business income. Difference between these two, 4.5 lakh minus cost of acquisition with indexation, will become your capital gain. Any questions for anyone, guys? See, even if it is a mistake also, just be proud that you made an attempt. Okay, you know what you don't know. Now you can work on it. Okay, just waiting for answer, I would definitely say that is not a correct attitude. You give an effort, let it be wrong, but you learn from it. Okay, so is there any conceptuality is not clear anywhere? From business, this is a time it is becoming a stock in trade, right? This is a business. This is the time it was a capital asset. This is a capital gain chapter. Okay, so we have few more questions. I'm going to the next question. Let's see whoever will answer it. And see, someone was replying, right? So I would request everyone to do it, guys. Vinay Kumar, Rajashekaran, and I don't know whether you are still on the Sai, Monica. So you can still answer it, because making a mistake also is fine, but try, give an attempt. You can expect some 5 to 6 marks, 4 to 6 marks on these questions. I will help you out if in case there is a doubt in application, but give an effort. Usha purchased 1,000 equity shares in P Limited, an unlisted company, at a cost of the unlisted. You don't use that normal section. Unlisted company at a cost of 30 per share, brokerage 1%. She got 100 bonus shares in August 2000 before 1st April 2001. Means you have an option of taking cost or fair market value, whichever is higher. This option is there for you. She again gets 1100 bonus shares by virtue of her holding in February 2006. 100 shares she got it before that cutoff date, and 1100 shares one more time. FMV on the shares on the April is 80, so you can take that 80 as your cost of acquisition. I'm giving you overview of answers. On this date, like 1st Jan 2022, she transfers all her shares of at 200 per share, brokerage is 2%. Compute the capital gain in the hands of Miss Usha for this year. Cost of indexation is given. So what you do is, all shares bole to initially she had 1000 shares, so you make columns are 3 tables. First she got 100 as a bonus, and again she got 1100 as a bonus shares. You do separately for 1000 because you know what is the selling price, transfer expenses, net consideration, cost of acquisition, you know it all. And for this 100 you do it which were acquired before that cutoff date, and 1100 you do it again, and the answer will be very easy. 4 marks ke liye you can expect, not 6 marks, you can expect 4 marks. I'll wait for 2 minutes. Let's give a best shot. If you don't get it, it's fine, but just give a try. I want you to apply it, guys. Then only the sessions are beneficial for you. This concept anybody can teach. There is not like this is very difficult concept, you know, but how you are applying in a question is nobody can teach. You can try it now. Vinay Kumar, I will upload the PDF. Please focus on the concept and topic. Please involve in the session. PDFs are not like very big thing. It's just a compilation of all your previous question papers and previous illustrations. It's okay, I will share, no issues. Hello guys, this is the question relating to bonus shares. You need to find out what is your capital gain with the 3 different things. It is 9:34, so I will start my answer at 9:37. So 3 minutes are there. Let's see who can do it. 9:37. See, if you are able to answer, then I feel that my content is reaching out to you. I'm making your concepts clear, or else I'm not successful in conveying the topic. Two more minutes. Yes, you will take it. One more minute. So I want to answer in 3 different ways, guys. What is the capital gain or loss with respect to each item? Original shares were 1000. Bonus shares 100, bonus shares 1100. This is the answer I'm expecting. Yes, you will have bonus indexation. Yes, you will take the brokerage paid as also transfer expenditure. Yes, guys, cheer up. Don't think that I will do it later. I understood. Not like that. Try applying now. No, you had to do it separately for three. First I said for original 1000 के लिए you do it separately. See, answer is very simple, guys. 200 per share, right? He is selling 1000 multiplied by 200. So will consideration minus is paying a brokerage of 2%. Minus 2% you do it. Net consideration minus cost of indexed cost of acquisition. When they bought it at in the year of 1996. So 1996 बोले तो you take the base 2000 as a CII and the current year CII is what? 317. So 317 divided by 100 and multiplication. So answer is 57,600. Check this one. This is 57,600. Nobody is bothered to answer only. This is discouraging for me. Separately you do. That's what I said. No, original separate, bonus shares first tranche separate, second separate. Okay, I'll reveal it. We are getting late in the topic. Yeah, so for original I told you had to do it separately. For original 1000 shares, 1000 multiplied by 200, that is the sale price. Sale proceeds, brokerage 2% he paid, so net consideration is 196. And the cost of acquisition, he bought it for 80 rupees initially. Initially he bought it at what rate? 30, but you have an option, right? If the assets are acquired before 1st April 2001, you have an option to take either cost of acquisition 30 or fair market value on the date of 1st April 2001, whichever is beneficial. But the 80 you will take 80, and CII of current year multiplied by, you don't have CII for 2000 but you have CII for the April 1 to 2, right? So that you can take it as 100. So this will be your cost of index cost of acquisition. This is a capital loss. Next 100 के लिए, this also you sold it for 20,000 and brokerage is 2%. This is the net consideration and the cost is again 80. You might say why we are not paying 80? Because the assets are acquired before 1st April 2001. So you have an option, even though it's a bonus issue, still you have an option. So 80 will take it, and this will be your long term because the period is more than 24 months, right? Yeah, 24 months. And 1100 bonus shares, that is the second time bonus shares के लिए sales proceeds 1100 multiplied by 200 and brokerage 2% net consideration, and cost of acquisition will be nil because they were acquired post 1st April 2001. So this will be nil. So long term capital gain will be this much. Yeah. We have another question. Is anybody interested to solve this question? It doesn't seem like that. So I'll take the provision only, guys. Numbers, people are not interesting. Yeah. So cost of improvement में for goodwill, cost of improvement is always cost of improvement is always nil, and for any other capital, whatever you actually pay, that will be your cost of improvement. This question I will be giving guys. This question you need to solve. That bonus wala question I am leaving for time being. Let's see if anybody still wants it at the end of our session. We will solve few more questions. Okay, so this question I'll read, and again it will be you who will be solving it. X and sums HUF purchased land for this rate in the previous year 2002 to 3, in the previous year 6 to 7. A partition took place when Mr. A co-personer, is allowed this plot valued 1.5 lakh in the previous year. Sorry, allotted, which means there is a partition of HUF. You know that when there is a partition of HUF, there is not a transfer. 7 and 8, he had incurred expenses of 235,000 towards fencing of the plot. This is a cost of improvement. Mr. A sells this plot of land for this much in previous year 21-22 after incurring expenses of 20,000. You are required to compute the capital gain for the year 2022-23. It appears to be small, but in this question you will understand how to apply the cost of improvement. So go back to your section 48, computation of capital gain. Your selling price is this much, cost of transfer expenditure is this much. You will find the net consideration, and you have a cost of acquisition. You have to apply here what is the cost of acquisition in case you are receiving the asset from your previous owner. I'm not giving you the answer. You ask yourself. You are a son, because of partition of HUF you are being allotted the land. Okay, now what is your cost? You think like that. And then you have also incurred improvement cost. That is also improvement. Should you apply cost of index or cost of improvement or not, depends upon the period of holding. If it is more than 24 months, you apply the indexation also. Now you tell me what is your capital gain on this. Just to focus on the numbers. Don't write anything. Don't like a fancy thing like drawing with a scale. Nothing like that. Just application. I will wait till 9:46. 2 minutes. I know only few people are there, but let's give a try. I hope question is visible properly in my mobile. It is visible. So my mobile is a chota mobile, so obviously it will be visible for you also. Let's see who will answer this quickly, guys. I'm eager to solve this problem or make you solve this problem, provided you also show some enthusiasm solving it. 54,234. No, Jacob, your answer is wrong. Try again. Anything you did wrong. Sale consideration 15 lakhs. I think you are taking this properly. And transfer expenses is 20,000. So 14 lakh 80,000 will be your net consideration. And cost of acquisition is cost of acquisition to the previous owner. What is the cost to the previous owner? 1,20,000. When they bought it 2002 and 3. Had they bought it before 1st April 2001, we would have taken actual cost or fair market value, whichever is more beneficial. But since it was acquired post 1st April 2001, we will take the actual cost. What is our provision in case of partition of HUF? Cost to the previous owner will be cost to you. So 1,20,000 multiplied by CII the current year 317 divided by CII of the year in which the previous owner took it 2002 to 3 bole to 105. Yes. Not 105. Okay, so there is a confusion here. There is a case study. I will explain that also. Manjula J. Shah case study. As per that case study, you should start the indexation from the year in which the previous owner first held the asset. Because if you go back to the proviso of section 48, that is a cost indexation formula they will give. The indexation formula is like this: cost of acquisition or cost of improvement multiplied by CII for the year in which the asset is transferred divided by CII for the year in which the asset is first held by the assessee. So as per that provision, we should start the indexation from the year in which your father, like the previous owner, is first held the asset. If you are going with Manjula Jesha, that case study, otherwise you can go with when you acquired it. When did this fellow acquired it? 6 and 7, so 122. Either way it's fine, just write a note saying that cost of acquisition has been, indexation has been started from this year as per the case study, if you are going with the previous. Otherwise you can take directly 122. And cost of improvement ke liye he has spent 2,35,000 multiplied by when did he incur the improvement? 7 and 8, 122. Divided by 317 divided by 122, 127 and 8, no, 129. Okay, so the calculation you do it later, but now the focus is that because you are getting the land because of partition of HUF, you take the cost to the previous one. That is point number 1. Point number 2, indexation you start from the year in which you first held it. Normally that's fine, in examination also you will get the marks. Otherwise, if you want to write that Manjula Jesha, that case study, you can take the indexation from the year in which the previous owner held the asset. Okay, cost of improvement, whenever you are incurring that cost, that will be considered. And computation of capital gains in case of depreciable assets. Remember one thing, generally 43.6 will talk about the WDV we have done in our PGBP only. You will have opening WDV, then you have anything cost of acquisition, whatever you acquired during the period, and then sale, whatever sale like payable, all will come, and you will have WDV for depreciation. On that you will calculate depreciation under section 32. So why are you taking PGBP here? Yes, because if your block is like this, and whenever you are selling something in a block for an amount more than your block, now my block is having, you can take either, both are correct answers, just write a note, both are correct. Okay, if you are taking previous owner, like if you are taking, make sure that you write Manjula Jesha case study. If you can't remember that, take 122. Yeah, so coming back to this, if you are selling a depreciable asset at a price more than your opening WDV, acquisition and selling price, then you will end up having a short-term capital gain or short-term capital loss. Or you have 10 items in a block, there are 10 lorries, example 10 lorries, you are selling 9 lorries for a price which is more than the block value. So you will end up having 1 lorry with you, but the value is 0. So when the value is 0, you cannot charge depreciation. Put it simply, put it clearly to match your section 32, section 46 WDV with your section 50. For you to charge the depreciation, there should be some value, or there should be some asset. Example, I have 10 computers. So after 4-5 years, at least there should be 1 computer for me to charge the depreciation. Maybe for 1 computer also I can still charge whatever is the closing WDV, on that I will charge the depreciation. Even it looks like funny also, still I will charge it. So 2 conditions has to be satisfied. At least there should be 1 asset, at least there should be at least there should be some value. Put it other way, 1 lakh is a value of a laptop, 10 laptops I bought it, so 10 lakhs is the opening WDV. I am charging depreciation at the rate of 15% for the first year. So 40%, 40,000. So 60,000 will be WDV at the beginning of the year. So if I am selling it for 70,000, out of 10 computers I am selling only 8 computers. So out of 10, 8 have been sold, but the selling price is more than my WDV, no. So I cannot have a depreciation for that particular year. I will have only 10,000 as a short-term capital gain. I am repeating, even though you have capital asset in your block, but the value is 0, you will not charge depreciation. That will become your short-term capital gain or short-term capital loss. Take other way, other question. 60,000 is a WDV. You are selling all the 10 laptops, but only for 40,000, all 10. So 20,000 value is there. Should you charge the depreciation? No, because all are done, right? You don't have any asset with you, so you cannot charge the depreciation. I'm repeating one more time, one last time. For you to charge the depreciation, there has to be an asset, one asset and undali, plus there has to be some value to it. Otherwise, it will end up having a short-term capital gain or short-term capital loss. Even though asset is held for more than 24 months, it will never become long-term. Okay, a depreciable asset can never become a long-term capital asset. It will not be eligible for depreciation. I thought of solving this question, but okay, so this question is not to be solved. You can solve it later. And slump sale is something like you are selling an undertaking, like you are a big manufacturing entity. You are having different segments of your business, like one in Middle East, one in South Asia, one is Asia, one is that APAC region, or this region, that region, like that. So one region you are selling it, or one branch you are selling, or one undertaking. That one undertaking having its own assets and its own liabilities. Example, if I'm taking classes in 5 cities, example, one city they will have, I'm maintaining separate books for one city separately. It will have its own assets, it will have its own liability. Entire asset and liability I'm selling it to someone else. That is called slump sale. So I'm not valuing what is the value of each asset, each liability, not like that. Entirely on a lump sum blanket amount I'm selling for some price, right? That is called slump sale. If that is the case, what is your selling price? Whatever the amount I'm getting, you apply section 48, you will understand. Section 48, what is sale price? Whatever the value for which I'm selling, that will be my sales sale consideration, minus transfer expenditure. Whatever the transfer expenditure I'm incurring, that will be the transfer expenditure. Then I will have net consideration. Then I need cost of acquisition, right? Indexation is not available for slump sale. So cost of acquisition, what is my cost of acquisition? Cost of acquisition, because I'm not, I have not identifying values to each asset, right? So entire thing I'm selling, so it's a net worth I'm selling, right? So you need to calculate the net worth for the entire undertaking. So that is the crux of the entire chapter, entire topic. I'll discuss more on this. So net worth, you have to calculate what is the net worth. Simply as per Income Tax Act, what is the value that you have to consider. If there is any revaluation, you have to ignore. Assuming there is a land, I bought it for 10 lakhs, now it is 12 lakhs. 2 lakhs is a revaluation reserve I created. I increased my land by 2 lakhs. That you have to ignore. Okay, you need to take the book values only. Okay, and plus for depreciable assets, anyway for income tax calculations you will be having WDV, right? As per WDV you take the values. So there won't be any indexation. You will be calculating the net worth. If it is held for more than 36 months, it is a long term and you will be paying tax at 20%. If it is a short term, you will be paying it at normal tax rates. And one more thing, if the value is more, I mean surcharge also will be applicable. Net worth may, if it is a depreciable assets, you will have WDV as per section 43(6), that you know it. It is a self-generated goodwill, nil, that also we understood so many times. In case of section 35, it's also nil, because 35 we are already done section PGBP chapter. It already you might have taken everything in your P&L, you have debited your P&L with the full amount, so it will be nil. In case of others, it will be book value. I'm repeating, revaluation you should not take, only book value you will take. For depreciable assets, income tax ke liye they have their values, so book value you will take, sorry, WDV you will take as per the income tax. If it is a self-generated goodwill, we have said so many times, self-generated goodwill should not be recognizing. If you are recognizing by mistake, make it 0. Okay, in case of section 35 AD assets, it should be 0, and in case of any other thing, you take the book value, something like your debtors, your prepaid expenditure. Okay, like that, maybe loans and advances you are given to someone, like that. And the stamp duty value, this concept is kind of same with your section 43 CA. Again we will be discussing here. whenever you are selling something, no, that is your sale consideration. We are understood this multiple times, section 48, section sale consideration. But the sale consideration is 100 and your stamp duty value is way beyond that, and the difference is more than 10%, you will take the stamp duty value. Okay, if the actual consideration is different from your stamp duty value and the difference is the variation is more than 10% of the actual consideration, you will take the stamp duty value as your full value of consideration. But if you feel that the stamp duty value is not properly valued, you will request the assessing officer to refer the matter to the valuation officer, and once he receives that, he will again value one more time on his own, and he will give his own report, he will give his own value. And if you feel that the value is beneficial to you, you will consider. If you feel that the value is not beneficial to you, you will not consider. But for you to request the assessing officer to refer the matter to valuation officer, things you should not be disputing in any court or tribunal anywhere. One side you are filing a case, or you are going for a higher level, and another way you are requesting. It cannot be happening too, right? Same thing like that, if you are just walking on the road, if someone comes in between, you either fight or you request. You cannot do both, right? If you are fighting, well, you are appealing. You are requesting, well, maybe that person will give you some way. You do only one like that. If you want the value to be referred to valuation officer, you don't go for any appeal, you just make a request to assessing officer. Okay, this I explained. So in words I explained, and in exam also nobody asks you in theory. You can go with the wordings that we are saying here. And advance money forfeited, this you can expect one question on this, maybe in income from other source chapter, but again I'll explain. 1st April 2014 is the only thing that you have to remember. Before this date, if you are trying to sell your asset and received an advance and you forfeited eventually, that used to be deducted from your cost of acquisition while making a sale. But post to this, it will go to your income from other source. Put it other way, I have a land or a building, 1st April 2014 is a cut-off date. I wanted to sell it for 1 crore. Someone gave me 5 lakh advance. So I received an advance of 5 lakh. But that person is not turning it up, and I am also forfeited it. I gave him 1 month period time. He didn't come in 1 month. So I forfeited. So this I forfeited. So earlier the provision was like, I will not pay tax on this 50,000. Eventually, whenever I make a sale, maybe when 10 years, 5 years, 20 years down the line, that time this 5 lakhs, I will deduct it from my cost of acquisition. Assuming my cost of acquisition is 40 lakh. Okay. At the time I eventually sell after 20 years, from 40 lakhs, I will deduct this 5 lakhs, and only on remaining amount, I will be calculating the indexed cost of acquisition. That used to be the case if the advance was forfeited before 1st April 2014, but if it is after that, it will come under income from other source. That's the only thing. Maybe in a MCQ you can expect this question. So having so far, we are coming to the last stage of our journey. The last stage is we have to know what are the deductions. For salary, you know your deductions are in your section 16, standard deduction, and PF deductions and all, right? For income from house property, section 24 will talk about your standard deduction plus your interest taken on interest on loan for acquiring the asset or house property or construction. I'm telling you, but that is a deduction, right? Now PGBP also section 30 says, section 37 all deductions. So every head is having its own, every family is having its own issues like that. Every head is having their own deductions. So salary may we have deductions, house property we have deductions, PGBP section 30 to 37 all are deductions. Now capital gain we have deduction in 54. Okay, this is the deduction with respect to that particular head. Now capital gains on sale of residential house, like I am having a house, I am selling it. So what are the benefits I will get it? It's only for individual and HUF, so it's not for a company. Every time you check this, it's only for individual and HUF. Conditions: there should be a transfer of a residential house, building or land appurtenant thereto, and it must be a long-term capital asset. Income from such is chargeable under the head income from house property, which means earlier also I was using it for my house property only, like I'm staying myself or I'm letting it out, either case, and because that is chargeable under income from house property, and I'm holding it for more than 24 months, I'm selling it now. So what benefits I will have? If the amount of the capital gain is exceeding 2 crores, 2 crores is like a very big amount, right? So if the amount is 2 crores, within a year before or 2 years after, I need to purchase another house, or after 3 years I need to construct. Like, you always remember these conditions. If I am selling here 1 year before or 2 years after, I have to purchase another house, or 3 years from the date of transfer I have to construct, because construction will take more time. This is the same for every provision, so I'm not going to repeat that. Meaning, if my capital gain is so much that it is more than 2 crores, you buy only one house. Okay, purchase within 1 year or 2 years after that, or construct within 3 years. Fine. Where the amount of capital gain does not exceed 2 crores, it's not 2 crores, it's like maybe 1.8 crores. So we are all middle class family. I don't know what thought they might have gone through. 2 crores, as if it's a very small amount, they are thinking. If it is less than 2 crores, you are afford to purchase 2 houses. Okay, 2 residential houses in India. I'll repeat one more. Same provision, everything will be same. Don't focus on that. It is understood. 1, 2, 3. 1 year before for purchase, 2 years after for purchase, 3 years for construction. That is clear. If the capital gain is more than 2 crores, you are allowed to buy only one house or construct one house. If the capital gain is lesser than 2 crores, you are allowed to buy 2 house properties. But it's only once in a lifetime. Again, out of that 2, you sell for higher price, and again you purchase 2. Not like that. Only once. So what is the quantum of exemption? Whatever the gain that you are having, if you are selling in somewhere else, I mean, like you are putting in another house property, then it's fine. Okay, everything will be allowed. Example, there is one example here only. I'll give long-term capital gain. This guy has got 2.05 crores. Okay, so he is allowed to purchase only one house or construct only one house. So he is using 3 crores. I mean, like such a rich person, he is using 3 crores. So that is the cost of the new house is more than the capital gain, right? So entire 2.5 crores is allowed as a deduction. Simply, there is no question of proportion. Only for few sections the proportion concept is there. For 54, nothing like that. Your capital gain, if it is more than this, entire thing will be exempt. If it is lesser than this, whatever you spend, that will be deducted. Example, 2.5 crores is a capital gain for one fellow, and he is using 1.55 only. So he is using 50 lakhs less, right? So 1.55 will be exempt. We should not be using the word exempt also. Exempt, remaining 50 lakhs may have to pay tax, or maybe you can use something else also. 54 EC, we have other benefits. But before 3 years, if you are trying to misuse this, then whatever the benefit that you got, that will be deducted from your cost of acquisition. One example they have given, within 18 months this fellow is selling it for 5 crores. We got this example now. 0.25 crores he got as a long-term capital gain. He is spending 3 crores purchasing a new house. Within 18 months he is selling it. He is selling it for 5 crores. So now what is the cost of acquisition? 18 months it is lesser than 24 months, not a long term, it's a short term. Is selling it for 5 crores, that will be the sale consideration, transfer pricing, transfer expenses assuming nil. And then cost of acquisition is originally he spent 3 crores, but is not his cost of acquisition. 3 crores mein what are the benefit that he got it, how much benefit he got it, 0.25 crores benefit he got it. So 3 crores minus 0.25 crores, only this much will be his cost of acquisition, remaining will be his short term capital gain. So it's not just here guys, same kind of a questions you will find it in multiple places. Logic is same. if you are getting a benefit under section 54, whatever it may be, subsequently there are conditions, you should not be transferring it within 5 years or 3 years depending upon the section. If you violate that provision, no, whatever the benefit that you got it earlier, that should be deducted from the cost of acquisition. Okay, you remember that one point. So next, agricultural capital gain on transfer of agricultural land. So 54 is for your general residential house, this is for your agriculture. Okay, the only thing is it is again useful, applicable only for individuals and HUF. The only condition is that you should be using it for at least 2 years prior to the transfer. That is the reason why, I mean, it's a old concept, but earlier people used to use it. I mean, now also some places they use it for agricultural purpose for 2 years, and they say that it's an agricultural land so that they can get more benefit. Okay. You should purchase another agricultural land, urban or rural, within 2 years. Such a land must have been used for agricultural purpose by the assessee being individual or his parent or HUF in 2 years immediately preceding the date of transfer. You should purchase another agricultural land, urban or rural, within 2 years from the date of a transfer. Okay, so here the question is again, from last 2 years you should have used it for agricultural purpose, be yourself, your family, your house, your spouse, your parents, whoever it can be. It should have been used for agricultural purpose, and within next 2 years you have to purchase another agricultural land. It can be rural or it can be urban, that's fine. Sir, why 2 years? Sir, within 2 years where should I keep the money? There is a capital gain account scheme, there is a separate account maintained in separate bank account, scheduled bank mein you have to deposit that amount wherever. Like 2 years also you cannot keep it at home, right? And you cannot use it in your general banking account also. You have to create a separate banking account, and that amount, that proof of submission there has to be submitted while you are filing the return of income, otherwise it is not accepted. Quantum, again same logic. Capital gains says zyada, like if you are investing in another agricultural purpose, entire will be exempted. If it is lesser than this, whatever you are purchasing or keeping side for the agricultural purpose, that will be exempted. And before 3 years if you try to sell it, same consequences that we saw it for residential house. It should be deducted, the benefit that you got will be deducted from your cost of acquisition. I'm not repeating the same point because the same point we have discussed already. Capital gains on transfer by way of compulsory acquisition of land or building of an industrial undertaking. So this is like a compulsory acquisition of industrial undertaking. See, generally they start their industrial areas, right? This area we are keeping only for agriculture industries purpose. But once the area develops, government takes their land, takes their capital land and building. It happens in every place. Initially they give it at the heart of a city, and after 15, 20, 25 some years it gets developed, overall area will be developed. Then the government is like, okay, I'll take your building, I'll take your land, you go somewhere else, I'll give you in some far away district, you go there. So that is a harsh for companies, but still because they want to have their own secretariat, or you can say some hospitals or jail. It's happening here. Okay, that's why I'm taking that example. So that's a benefit given to these people. You should have used it for 2 years. So there is no condition of it should be long term, because compulsorily acquired, how do you plan it? I bought something last year only, now government is compulsorily acquiring it, some asset, some machinery, so I'm selling it off. Obviously I have to sell, I cannot take everything to some other far place. So that's the reason why there is no condition of it should be a capital long term only. And within 3 years you should not be setting it up, you should not be transferring it. 54 EC, again this 50 lakhs is a very important section, guys. You remember the section also, remember the amount also. Within 6 months from the date of transfer you can have these bonds actually. So these bonds are very crazy bonds, so people buy it like within days and minutes also. So bonds are not like every time it's available, because this is one way 50 lakhs your savings, like you're selling one house and you're getting the money. You don't want to purchase another house because you feel that no, why should I block my money, or maybe I already have one building, so instead of purchasing another house I'll invest in this. So people take this as more beneficial, treat this as a more beneficial. So it should be long term capital asset. And you can invest in NHAI, Rural Electrification Corporation, RECL, These bonds you should not be transferring it for 5 years, and if you something happens like that, same treatment. But here maximum is only 50 lakh. If you violate, again it will be taxed in the year in which you transfer it. Questions, I'm not solving it. Capital gain in case of investments in residential house. So this is 54 is selling the house, residential house, and purchasing another residential house. This is selling any other asset other than residential house, but purchasing residential house. It can so happen, right? Again, same logic, 1 year, 2 year, 3 year, not going to explain that. Only for individual, you are selling any other asset, maybe gold example. You sold it, it's a capital asset, you got the gain, you don't want to purchase, you don't want to invest in 54 EC, you have an option, but you are saying, okay, I'll invest in a house only, or I will construct one house only. So 1 year, 2 year, 3 year, that is same thing. Plot also you can purchase, and it is proportionately bole to with respect to your net consideration how much you are investing. So I'll solve a problem for this because this is a little tricky. The following particulars compute this cost of jewelry, same example. I didn't read the question only, but I gave the same example. Jewelry, someone purchased it for 4,52,000. They sold it for 12,50,000. Expenses 7,000. So you know by now 12,50,000 is a sale consideration. 7,000 is a transfer expenditure. Number I'll do that. How much? 12,43 net consideration and cost of acquisition. You take the indexation 4.52 multiplied by when you are selling 317, when you are buying 117, you get some amount. We'll do that, and because it is a long term, so you will get long term capital asset or long term capital gain. And then what is he using? Okay, residential house is purchasing for 50, so he is going with a 54 F only. So now we'll do the calculations only. 12,43,000 is a net consideration, that's what we got it, and indexed cost of acquisition 452 multiplied by 317 divided by 117, so you are getting 12,24,650. 18,350 as your capital gain, but you are purchasing another house for 5 lakh. You think that 5 lakh is more than 18,350. Don't compare your capital gain with the new house purchase. You compare this new purchase with your net sale consideration, which is your 12,43,000. 12,43,000. I'll repeat once again. For other section, you are just comparing your capital gain versus what you are investing for 54 also. But here you will compare your new investment or new residential house acquisition with respect to your net consideration. So which means 18,350,000 is the capital gain, that is for 12,43,000 net consideration. So you are investing only 5 lakh, right? So how much you will get? Obviously the lower price net investment will come on top, numerator, denominator by net consideration, and multiplied by your capital gain. In other way of saying is, had you invested entire net consideration, I would have given you the benefit of entire capital gain. Because you are investing proportionately, I will give you proportionately. Put it in numerical mathematical sense. So this will be your long-term capital gain, which is taxable. Exemptions of capital gains for shifting of industrial undertaking from urban areas. So this is also kind of same like what we have discussed, that is a industrial undertaking. It is shifting, okay. This is not important, so this I want to take this, guys. Exemption of capital gain on transfer of certain capital asset in case of shifting of an industrial undertaking. It is also not so much important. I am not spending time on this. You can read again proportionately, you will do it. Okay, thank you, Jacob. Yeah, so sure. So our last point for the day is startup. You are selling one asset and you got the gain. You are not interested in buying another house. You are not interested in buying investing in 54 EC, but you are invested in starting your own business. So you are at the right place. Click the link below. Okay, so this is a section. I'll make you a millionaire in 2 days. Okay, just click this section, click the link below. Yeah, so here, as I explained you the context, someone has a long-term capital gain, but they don't want to start anything. They don't want to invest anywhere. They don't want to park the money anywhere. They're starting a startup. Now the question is, what do you mean by startup? I mean, like, as per this section, and what assets you should purchase, how long you should keep it, what should be your stake. Just we'll go with the layman understanding. Like, you are only selling your building for 1 crore. I mean, you got a capital gain of 1 crore. Now that whole money you want to start your own business. So we'll apply one point as to how it will be useful for us to. Okay. Yeah. Section 54 GB exempts long-term capital gain on sale of a residential property, house, plot or land owned by an individual or HUF in case of reinvestment of net sale consideration. Net sale also, they are not calculating on the basis of the capital gain. They are going back to your proportionate. In the equity shares of an eligible company, reinvestment, they are not saying you are making an investment like a trader. Not like that. You are starting your own business. Being an eligible startup which is utilized by the company for the purchase of new plant and machinery. So put it in a very layman and simple terms. You have a land or a building or a boat or any plot. You sold it for 10 crores. We'll take an example. 10 crores. You have a huge capital now. So what they are saying is, this money, if you want, you can go with 54 or 54 EC. Fine, but you are very rigid. You don't want to go anywhere. You start a company, bring the company. Okay, with this money, you purchase new plant and machinery, which again I will tell you, just like your additional depreciation. You remember yesterday whoever has attended the session for PGVP, additional depreciation also we told, right? I will give you additional depreciation for such a item, such a class of assets which are useful for the entity, like manufacturing or any factory or anything like that, and that will help generate more revenue, that will generate more employment, or they are taking economy as a whole. Okay, so here also purchase of new plant and machinery. Also, don't purchase one vehicle, whatever the vehicle that comes for 10 crores, I don't know. You purchase that and don't say that I have started my own business. Okay, it's not a business only. Only in YouTube you see that people show all rich cars and rich gadgets and say that, oh, I am rich, and you also click the link and join my session. But for any manufacturing thing, you cannot invest in your car and gadgets or Apple products, not or suit. You have to invest in your plant and machinery. You have to invest in your factory. You have to invest in all such stuff. Yes, coming back to our discussion, they say that your net consideration you have to use as a pipeline for your new business, and from there you purchase the eligible plant and machinery. Yeah, so in order to qualify, what you have to do is incorporate in the financial year in which the capital gain arises, or in the following year on or before due date of filing the return of income by the individual or HUF. As I said, it is applicable only for individuals and HUF. One thing. Second thing, if I'm selling it today, in this year only I'll do it, or next year before I file the return of income, like 31st of July tak, I can float a new company. Means I incorporate a new company. Engaged in the eligible business. What do you mean by eligible business? A business carried out by an eligible startup engaged in innovation. Something like there has to be some innovation, not like a fraud. development or improvement of products or processes or services. In this digital era, in this technology era, you try to innovate something, a new product, a new innovation, new technique or something of that sort. Okay, not just selling a random thing. A scalable business model with a high potential of employment generation or wealth creation. So it should not be so, it should not be like, you might have heard these things, I mean on YouTube you might have seen chain marketing, multi-level marketing, all these are kind of, only one person becomes rich, everybody will become sheeps only. Okay, one person only will enjoy. Not like that. It should be, the idea of your business should be scalable such that it generates wealth for the people, it generates, it makes something easy, it improves the quality of life, or it generates more employment of that sort. Okay, then you can say it is an eligible startup. Now everybody is using their own name as, I am only in startup, I am only in startup, nothing, no new creation is happening, but only a startup. Okay, so it should not be like that. Startup bola to some innovation, something improvement of a process, or some easiness, or helping someone in some way, or making an experience better, something like that. Yeah, so when you call something as a and one more thing, a company in which individual or HUF holds more than 25% of the share capital or 25% of the voting rights after the subscribers, means, just now I gave one example, right? 10 crores you got it, so 10 crores entire amount you are trying to put it in an investment in a startup. So 10 crores is for 25%, बोले तो remaining 30 crores you can raise it from the general public if you have good name in the market, or maybe from your friends, maybe from your other resources, other investments, somewhere or other. So but the one who is making this investment for this 54 GB, he's the one who sold that asset, his share should be minimum 25. Just like conversion of AOP BOI form to the company, I told you the logic of 50, no, here it is 25. So you should have at least 25% stake. And someone has just said, if you go to Shark Tank and if you sell off that 25% also, no, again you are violating this provision. You should hold at least 25% stake, even if you are offering for venture capitalist or angel investors, you have multiple places of bootstrap, whatever you do it, but you hold 25%. If your stake should not come below 25%. Okay, it is applicable, guys, it is applicable. So that is your eligible startup. I hope this is clear, though I am going fast. I know it's almost 3 hours, but still I'm spending time on this because I feel there can be a question around this, and it will be a really good question. 6 marks, I think 5 to 6 marks you will get it. Yeah, so it should be between this date, 1st April 2016 to 31st March 2022, and then the total turnover in the previous year for which the deduction is claimed. So means like when this is like a combination of another section. When we do our chapter 6A deductions, we'll talk about that also. Generally we know chapter 6A deductions both 80C to 80U only, that is for general public, but for companies also they have lot of other sections in 80 chapter deductions. So 80 IAC is for startups. So there the deduction that you're claiming there should not be more than 100 crores. Like if it is such a big thing, why are you worrying about this investment? Okay, and they should hold a certificate for eligible business from the notified ministerial board of certification. So you should get the government permission for that also. Permission also, like on the board you apply it, and if they feel that your business having a potential to grow, and they have their own parameters, and if you fulfill all those parameters and procedural formalities, they will be giving you a certificate. Which means that if I sell my land, long-term capital asset, and wants to start up my own business, in that year or the next year before filing the return of income, I should get my certification, I should start my own company, and I should subscribe to the share capital, which should not be lesser than 25% of the total capital. So that you understood, sir, that is very clear. I hope it is clear. I'm just self-claiming it. Now, when I want to see, the very purpose of investing in the startup, that company, is that with that money I have to purchase something, right? It's not just you incorporated and you enjoying the money. Companies, government will not be okay with that. The reason is that they want you to do something, man. You generate the revenue, generate the employment. So they want to purchase this in certain assets only. That those assets I will be telling you once. Just go back to your additional depreciation section 32(1) to A to B, something like that. So you go back to that section. additional depreciation, same questions, same points will be there. Any machinery or plant which before installation by the assessee was used either within or outside India, you don't want second hand machinery, you buy one new one only. I'm giving you benefit, no, 54 GB I'm giving you like good benefit, so you purchase new only, then only it is something like, you don't make it like a second hand market, you go with a good intention. Any machinery or plant installed in any office, so again for office premises same thing, additional depreciation was also not available for second hand, additional depreciation was also not available, available for office premises, special accommodation in the nature of guest house. Okay, so Narsimha Reddy has cleared his CMA first group, so congratulations, I'll give you one smile here. So so I love to read such comments when someone says that they cleared it, that makes me really happy. Yeah, so all the best for your second group also. Now what are the assets for which you are not eligible? One is second hand, second is office में administration के लिए, guest house के लिए, don't use it, and then computers are also not eligible, but there is a one condition for this: if your invention is directly relating to the computers only, I mean you need computers, without computers you cannot make such invention. If your business is such that you are still allowed to purchase the computers. Vehicles, just now I said, just because you want to show up in front of everyone in a social media, you are purchasing all rich vehicles. No, it doesn't happen. You purchase a machinery, land, building, all those things, not your vehicles or all expensive gadgets. Okay, and again section 35 AD, like here you will find everything 100% reduction in a single year, right? You don't purchase those items also. Or maybe I can say low value items, certain items you can directly charge it to your P&L in a single year, that is also not allowed here. So quantum, compare your investment in the startup with respect to your net consideration. Okay, it means proportionately you have to consider here. And the reference to valuation officer, I explained, there is no need to explain this again. Yeah, here pay some attention guys. Tax on short-term capital gain in respect of equity shares, units of an equity oriented fund, units of a business trust 111. See, for other short-term capital gain, others other than this, it is 111. 111A is only for these financial instruments like equity shares, units, business trust units. For this it will be 111A. So remember that A is only for these instruments, other scale it's only 111. Yeah, so it will be taxable at for short-term capital gain on these instruments, equity instruments and units of equity oriented funds and business trust. It will be taxable at 15%. These three: equity shares in a company, units of unit trust, equity oriented funds, and units of a business trust. Condition is that this should be after 1st October 2004, because that is the day when this amendment has happened, and it should have been tax, it should have, STT should have been paid. The only thing, I mean, you forget this condition also, not example, because it's a long back, like 2004 both 19 years back, so it's almost like certain that transaction is happening in the near future only. For equity shares in a company, units of a equity oriented fund, or units of a UTI, okay, business trust. Yeah, so for these the tax rate is 15%, provided you pay STT while purchasing it. STT is not applicable if that is located in the international financial service centers, because the transactions takes place in the foreign currency. So for that reason, generally STT should be there, but for non-residents who are directly dealing with this international financial service center where it is exempted from paying STT, it's fine. Even without paying STT also, you can still end up paying 15%. Like for those, it's not required, that's not a condition. And unexhausted basic exemption limit is a concept, I'll tell you once. Short-term capital gain you got 2 lakh rupees. Okay, no other income. But basic exemption limit is 2.5. Basic exemption limit is 2.5. So now should you pay 15% on this? You should not pay. The reason is, assuming this short-term capital gain is your main income, only income, your basic exemption limit is 2.5, but you are getting a gain of 2 lakh only. So 50,000 is not yet exhausted, means you are not even reaching basic exemption limit, but why are you paying it 15%? This is little bit harsh, right? So for that, what they said is short-term capital gain and compare with the basic exemption limit. If it is, there is a difference, that is called unexhausted basic exemption limit, that you can wipe off from your short-term capital gain, like 2 lakh minus 50,000, only 1,50,000. This you pay it at 15%. This is applicable for residents only. Resident, individual and HF, only for those people it is applicable. And with the short-term capital gain, you are not allowed to take any section chapter 60 deductions. Some people ask, no sir, generally I get calls also on this, sir, I'm getting income from my, like some investment like shares or something like that. I made investment of LIC also, can I claim that LIC, that life insurance with this? The answer is simply no, because when a specific rate is given in the act for anything, you cannot have this chapter 60 deductions over there. So chapter 60 deductions are not applicable and not available to them. That is short term. Now we'll go to long term. 112, long tax on long term capital gain. Here also it is taxable at 20%. For individuals, resident individuals on HUF, they can get that unexhausted basic exemption limit. Just now the concept that I explained there, same concept you can use it here also to get it exhausted, and you will not get any chapter 60 deductions here also. For foreigners, they will be paying if it is unlisted securities or not being a company in which public are not are substantially interested, like closely held companies, like non-residents are investing in unlisted shares or closely held companies. For them, you will charge at 10% without giving any indexation, and they will also not have foreign currency fluctuation ke liye we discuss provision, right? That provision is not applicable to them. Like for this, if you are investing directly in the unlisted equity shares and closely held companies, you will pay 10% without taking any indexation, like first provision to section 48 or second provision to section 48. Both are not applicable to them. Directly they'll pay it at 10% without taking any benefit. And for listed securities and zero coupon bonds, for non-residents, there is one option. Option is 10% with indexation or 20% without indexation. I'll repeat. If the non-resident is investing in listed wala, like listed securities and zero coupon bonds, he has an option, like obviously beneficially, whichever is beneficial, 10% without indexation or 20% with indexation. Chapter 6 deductions will not be given. It will not be given to anyone, guys, to be simple. And long-term capital gain in respect of equity shares in a company or units of equity oriented fund or a unit of a business trust, it will be taxable at 10% beyond 1 lakh. See, earlier it used to be exempt 100%, but now opposed to 1 lakh you will be paying tax on this 10%. Condition, again same thing. In case of equity shares in a company, STT has to be paid on acquisition and transfer, but for units it has to be paid only on the transfers. So I know only few people will be interested in understanding this, but whoever is there, for equity shares, while purchasing, while selling, both times you have to pay STT. For you to pay tax only at 10%, but for units only at the time of sale you have to pay STT. If that is the case, you can pay 10% post 1 lakh. earlier 100% used to be exempt, but big fishes, they are like enjoying this section unnecessarily. Okay, see, 12 months also not a big time, right? Like now India is investing like anything crazy. Lot of people are investing, some trading or something they are doing. So 12 months is like, some people hold it also, not like everybody do the day trading, but if it is held for more than 12 months, it's a long term. But only 1 lakh tak you have the exemption, like not taxability criteria. Post that you will be paying 10%, but subject to that you pay the STT. Generally it is automatically taken, but as per section, STT has to be paid at the time of purchase, at the time of sale. If it is a share, for units it is only at the time of sale. Again, IFSC, for them STT the condition is not there. Again, basic exemption limit exhaustion also you can take it, just like how I said it for 11A, 112 also, same thing here also. Post that 1 lakh, if it is below that 2.5 lakh, whatever is the basic exemption limit for you, you can take that benefit, but it's only for individuals and HUF, not for company or any other thing, AOP or BOI. It's not for anyone. Chapter 60 deductions you cannot claim it, and you cannot claim the rebate on that also. So I hope this session is useful, guys. Whoever has attended, I sincerely hope that you got little benefit out of it. If you have any questions, I will just wait for a couple of minutes and then I'll wrap it up. Any questions before we close? Sal sir, em questions levantara. Okay, I hope I tried to complete majority of the portion. Few illustrations I have solved, few illustrations did not find time. Okay, so thank you. Keep working, keep practicing the problems. Provisions you can watch it from my videos. I do my best. I do my best to explain you the provision, but eventually you have to solve in a piece of paper. Then only your concepts are really tied up. Watching PGBP 10 times, 20 times, it's good, your concepts will be clear, but you take your institute material, CA, CMA, inter, final, whatever chapters are same, guys. Okay, you take those previous year's questions, current questions, test your knowledge questions, see the question, you try to apply in your notebook. Once you apply everything, you see the answer. If it is coming correctly, it's correct, be happy. If it is not coming correctly, you understand whether your concept is not clear or your application is not clear. If its concept is not clear, you watch any video who is teaching you that concept. But if the application is not clear, don't blame anyone. You only apply better for the next step. Okay, so thank you, Jacob. Thank you very much. Okay, so good night. Thanks for watching. Have a nice day. We'll meet in the next video.